So, chapter 14 will get started in today. This is the second chapter of mortgage lending and financing, or financing one, conventional FHA and VA loans. This chapter, we're going to talk about some different types of loans. We're going to do a little math. We're going to describe the issues concerning mortgage financing, including various payment plans and distinguish the differences among conventional, insured, guaranteed loans, and New Jersey's different home buyers programs that may be available. So, as I put my phone on silent, we can get started here. All right, so when people buy houses, usually they don't have all the money that's required to purchase, right? So they get loans. So the Why do lenders loan money? Well, so that they could charge interest and earn interest on those loans. So interest, think of it as the rent that we pay for using someone else's money. Okay. Um, there's got to be something in it for the lender, after all, right? And yeah, there's a lot in it for them. Um, Now, value, anytime we're trying to figure out what value is, we're trying to figure out all of it. So value means 100%. LTV is how much the lender will loan you in relation to the appraised value of the property. So an LTV ratio, LTV stands for loan to value ratio. It's how much the lender will loan you in relation to the value of the property. Okay. How much the lender will loan versus the appraised value of the property. An example of an LTV would be 80%. That means that the borrower has to put down 20% and the lender will loan you 80%. They'll loan you 80% of the appraised value if the LTV is 80%. So, like if it's an FHA loan, FHA loans only require 3.5% down. So the LTV on your average FHA loan is 96.5. They'll loan you 96.5%, and you only have to have 3.5% to put down. Okay. So we understand how LTV ratios work. It's that simple. That's all it is. How much the lender will loan you in relation to the value of the property. Okay. So equity. What is equity? Equity is the difference between the market value of a property and what is owed on it. Okay. So equity can be built in several different ways. Paying down the debt. So usually at the time you purchase a property, your equity is equal to your down payment. That's how much you have built in value into it. So paying down the debt at the time you purchase the property, market values increase, building equity, or you do home improvements, forcing an increase in value that builds equity as well. Um, and just the market values increase there, that number two, that's like the market values, they just fluctuate, they go up and down. Real estate markets are cyclical, so you could gain equity just by the markets fluctuating. All right, so interest, here we go. Interest is the rent the borrower pays for the lender for the use of their money. And once again, the LTV, what the LTV ratio is. Here's just where we're highlighting it in the book. Now, LTV ratios, as you can see, they increased from 40% in the 1920s to as much as 95, 100%, or more today. Payment periods have also lengthened from 5 years in the 1920s to as much as 30 years or more today. Wow. So imagine that. In the 1920s, to buy a house, you needed to have 60% of the cash to put down because the LTV was 40%. That means they'd only lend you 40%. You needed the other 60% cash to put down. And they'd only give you 5 years to pay back that 40%. All right. So the interest rates that are charged by lenders, they fluctuate as the markets change. They go up and down all the time. So as interest rates move up, an established fixed rate mortgage with a low interest rate could be a plus when selling the home if the new buyer is able just to assume that loan and take over those existing payments. So on the other hand, if mortgage interest rates fall, they may be better off seeking a new loan at a lower interest rate. And to buffer the effects of unstable money markets, lenders have been offering many alternative forms of mortgages in recent years, like adjustable rate mortgages. Seller financing gains in popularity when the banks and the lenders are not lending the money out there. So for years, potential homeowners have been able to receive assistance by obtaining low down payment mortgage loans through the FHA, the Federal Housing Administration, which insures loans. They don't make loans, they insure them. So basically, if you go to get an FHA loan, you're not getting it from the FHA. You're getting it from a local lender somewhere. And the FHA just insures that loan. They insure that lender against loss. They say, hey, if this borrower meets our loan qualifications, if the property meets the qualifications that we set forth, lend them your money and we will insure your loan against loss. So if that borrower defaults, we will make you whole that you won't lose a penny. Okay. Um, and the Department of Veterans Affairs, the VA, they also don't lend money. They used to, where there aren't any banks that are lending for that, but everything's online these days, right? So the Department of Veterans Affairs, they give loans to veterans, to military personnel. Um, and that you could get as much as 100% financing today. In addition, private mortgage insurance companies offer programs that enable loan applicants to receive higher LTV ratios from lenders like the FHA. They all insure loans, only 3.5% down payments required, whereas the normal conventional loan is typically 20% down. Okay, so interest rates fluctuate on the markets on a regular basis. When interest rates are high, alternative forms of financing can be more attractive. This is just summarizing everything from the previous page. Adjustable rate mortgages are referred to as ARMs. They become more enticing when they have teaser rates for you to get into them, and they could be fixed for the first year or a couple of years before they become adjustable. And that during that period, they're at a lower rate than what most people are getting offered in the market. Seller financing becomes attractive if they offer it. Now, government programs that have higher LTVs means that they'll lend you more money. FHA, VA, we have a state program called the NJHMFA, that's the New Jersey Housing Mortgage Finance Agency. Or you could get it right through the USDA. The REC-D is the Rural Economic Community Development. They give financing to people who live in rural areas. So rural areas of the state, you could get loans directly from the USDA, yes, the Department of Agriculture, for as much as 100% of the LTV. Okay. Ah, okay. So here's a graphic I had AI put together for us here, explaining what urban, suburban, and rural areas are. It's better than my other graphic where I just put a bunch of dots in a circle and then more dots in another circle. So as you can see, the urban area, these are highly populated, densely populated areas. A lot of high rises, apartment buildings, a lot of people living within close proximity of each other. Suburban is a little bit lower, a little bit less densely populated. People are spread out a little bit further. So that's suburbia, maybe single family or two family homes. People live a little bit further away from each other. Okay. And then we have rural areas. These are people that are living out like in farmland or out in the country. They live a little bit further. Maybe you don't see your neighbor because you've got quite a distance between you, or you could see them, but they're a distance away. They're not going to hear you shouting to them. Okay. So that's what the difference is between urban, suburban, and rural areas are. Hopefully that graphic made it a little bit easier to understand. It's not just farmland like it looks like they have here. So, like you have a regular house over here. It's just that they're wider spread apart. Another little graphic depicting the difference between urban, suburban, and rural. The city, densely populated areas, high rises, and apartment buildings. Suburbia, the suburbs, less densely populated areas with single and multifamily homes. And then we have the countrysides and farmland, the sparsely populated areas. Okay, that's uh, rural. So let's look at payment plans on fixed rate loans. The word amortize means to kill off slowly over time. And that's what you do when you get a loan. You make monthly payments on it, slowly killing off that debt over a long period of time. The typical loan is 30 years, so you're killing it off over 30 years as you make your payments. It applies towards interest first and then the balance towards the principal, the amount you borrowed. So you're slowly killing that, agonizingly slowly killing that loan off over time, right? That's what the word amortize means, to kill off slowly over time. So therefore, in a fully amortized loan, you're fully killing it off, the debt, right? So to fully kill off the debt over time, that's what a fully amortized loan is. The payment amount doesn't change from the first payment to the last payment. They remain the same. The only thing, that's if it's a fixed rate loan. Uh, the only thing that changes is how much gets applied towards the principal and how much gets applied towards the interest. Usually, interest is heavily charged up front towards the beginning, first half of the loan period. And then the balance gets applied towards the principal. And then about halfway through, it starts to switch. More of your monthly payment gets applied towards the principal than the interest towards the end. So by the time last payment is made, the loan's been fully amortized. The balance is zero. It's been fully killed off, but your monthly payments remain the same throughout. It's just how it was applied towards interest or principal. Okay. Now, why do you suppose lenders apply the majority of your monthly mortgage payments towards the uh, uh, interest rather than the principal up front? Why don't they just make it 50-50, applying half your mortgage payment towards the interest payment and half of it towards the principal? Why do they put most of it towards the interest at the beginning? Why would you suppose? Take a stab at it. Take a guess. Anybody?
So the lender could get most of their money back up front.
Okay. And why would they want to do that?
Just in case you don't fulfill your part of the loan agreement. I'm sorry, that's just my assumption
I was
based.
just asking for your opinion. That's all I was asking for.
Yep.
Anybody else? Yeah, anybody else got some ideas too? Because that sounds good, but what other reasons?
I need to be excused 1 second. I gotta make sure my
Okay,
puppy goes out. I'll be
no
right back.
problem. No
Uh,
problem.
the risk for lender slows down when the payment is paid much in advance in the initial months.
So if they get most of their money up
Most
front,
money
they
upfront
have
here.
less risk of the borrower defaulting.
Yeah.
They can default towards the end of the loan just as easy as they default towards the front. Um, but I guess they do get a lot of their money back that way up front if they do default. So well, it's minimized at some portion. Well, what about another idea? How about this? How long on average do people stay in homes these days? If you don't stay in that house for that full 30 years, they don't get all of
Yeah.
their rent, their interest paid. So
Mhm.
that's why they charge you heavily up front because on average, people stay in homes 5 to 7 years. And we've seen it even dropping below that. I've seen some as little as 3 years, and people are already looking to sell the house. You know, so if they collect that rent, that interest up front, it's less of a worry. Then they get more of their money up front that way. If you
Three
pay,
years after buying a house?
yeah,
3 years, okay.
yeah, as little as 3 years, and people are already moving after buying a house. Isn't that kind of crazy? Why don't you just
Yeah.
rent? Um, Well, everybody wants to be the boss, and you don't have to live near the factory where you work anymore these days. You've got people, they've got careers and jobs that we don't make much here in the United States anymore. Everything's imported pretty much. So um, that's a separate issue. That's a national security problem. But we have more people in types of jobs that want to be managerial and things that you could do remotely. So people, they don't have to live near where they work, and they could move more often or further from the jobs. So that's what's happening. On average, it's 5 to 7 years, but we are seeing some people as little as 3 years in houses. So a straight loan is an interest only loan. A straight loan is meant for short periods of times. Builders often use them. Um, you're making payments on the interest only. The loan will never amortize. Um, well, eventually it does, because they only allow you to have an interest only loan for so long before you have to start paying it back. And these types of loans are usually paid back in full. Um, so these are interest only payments, so they'll never pay down the principal. They're often used for a second mortgage as a bridge loan. When you're when you're buying a new home before you sell your existing one, sometimes it's necessary to get a bridge loan to be able to make payments on both of the properties until the one existing property is sold. We usually try to coincide closings when somebody's selling a property and buying another. As long as we coincide within 30 days, within the same month, they don't have to worry about making two mortgage payments that month, right? But sometimes that's not possible. And if that's the case, most people can't afford to make mortgage payments on two houses at once. So this would be an option for them to be able to get a loan, to be able to swing the payments in the interim until they're able to sell off their existing home and pay off the balance. Um, and that's why bridge loans are sometimes referred to as swing loans or interim financing. All right, and then we have short-term. They're short-term loans. They're used by people who fix houses up and flip them, and builders as well. Okay, you don't get a straight loan to buy a house that you're going to live in. Okay, these are meant for like investors, for fixing and flipping properties, or for bridge loans when you have to buy the new home before you sold your existing one, so that you could swing the payment on both properties. Uh, they're usually not meant for longer than 6 months. So let's do the highlights now on the word amortize, and where payments get applied to interest first and then to the principal over the term, whatever that term is. These are sometimes also referred to as self-liquidating loans. Just let me know when you guys got the highlights, please, so that I can move on. If you're not taking the notes, that's fine. Just let me know if you're ready to move on, or if anybody needs more time. How about that? Okay, we'll move on unless anybody asks me to hold up. Okay, so in a partially amortized loan, once again, amortized means to kill off slowly over time. So in a partially amortized loan, you've only partially killed off the loan by the time you made the last payment. What? What kind of situation would cause that? Well, if your monthly mortgage payments throughout the term are lower, that means by the time you make your final payment, um, it's going to have to be larger than the rest of them to fully amortize the loan. And that larger last payment is called a balloon payment because it balloons in size. Make sense? So, a biweekly mortgage, a lot of people misinterpret this as two payments a month. You're not making two payments a month. It consists of half payments made every 2 weeks, the equivalent of 26 half payments a year, the equivalent of 13 monthly payments. Wait a minute. How many months are there in a year? 12. So you have one, this is a way of you building up money to have one entirely extra payment applied only towards the principal. If you could do that once a year, once a year, um, where you could have one extra payment that gets applied entirely towards the principal, you could reduce the time of a 30-year fixed rate loan by 7 or 8 years to 23 or 22 years just by making one extra payment a year, applying it only to the principal. And that's saving you that much more because you're killing off that debt quicker. And because you're making larger payments towards the principal only. And when you do that, they can't charge you interest for all of that time. So you're saving all that money on interest payments. Imagine saving 7 to 8 years of mortgage payments that are interest. That could save you a lot of money. How much money? Well, uh, on a 30-year, 5% interest loan, uh, at if it were to reduce your loan by 5 years, that's a savings of about $50,000. It's a lot of moolah. So here we could highlight what a fully amortized loan is, what a straight loan is, it's interest only, what a balloon loan is, or balloon loan, a partially amortized loan is with a balloon payment, and what a biweekly mortgage does.
What kind of questions comes from these chapters? The maths or the terms like this or both?
You get you'll need to know about the different types of loans. Yes, straight loan is an interest only loan. You need to know that. What type of loan does not fully amortize, uh, and by the last payment, it's larger than the rest? What do you call that last payment? The balloon payment. Okay. Um, what type of loan has balloon payments? Partially amortized loans. In a fully amortized loan, your monthly payments get applied first to what? And then the balance to what? First to interest, and then the balance to the principal. So here's an example of comparing a 25-year loan to a 30-year loan. It's a little bit different than making a extra payment every year, but this could still show you how much you could save by lowering the number of years on the loan. This is different calculation than if you made an extra payment every once a year, applying it towards the principal. But just take a look at these two different types of loans. One's a 25-year loan, one's a 30-year loan at a 5% interest rate. You could save, let me see, by the time you make your last payment on a 25-year loan, you would have paid $526,500 for borrowing $300,000. And for the borrowing $300,000 on a 30-year loan, you would have made $597,960 in principal and interest payments. Now, how much of that is interest? Well, subtract the amount you borrowed from that and you'll get the answer. You borrowed 300,000, so that's your principal, and then you're left with $226,500 in interest payments on the 25-year loan and $279,960 in interest payments on a 30-year loan for a grand total savings of $53,460 just by having a loan that pays off 5 years sooner. That's how much you would save on interest payments. You will get a question about this math on exams. Don't worry, I have another. We'll bring this slide up again where I show you, I break it down how you figure that out. First you figure out what the monthly what the loan factor is. The loan factor is a chart I'm going to show you how to read, and it shows you what your monthly mortgage payment is per $1,000 borrowed. So for every $1,000 borrowed for a 25-year loan at 5% interest, that's $5.85 per $1,000 borrowed. And for 30-year loan, it's $5.37 for every $1,000 borrowed. Okay, that's how they come up with your monthly mortgage payment. That's your principal and interest. And then the key here is figuring out how many months are there in a 25-year loan versus a 30-year loan. You just take 12 months times 25 will give you 300 months for the entire term of a 25-year loan, and there's 360 months in 30 years. Now, if we figure out that we borrowed $300,000 per $1,000 borrowed, so 300 times the factor will give you your monthly mortgage payment of principal and interest. So to borrow $300,000 at a 5% interest rate, your monthly mortgage payment is $1,755. And for a 30-year loan for $300,000 at a 5% interest rate, it's $1,611 a month. So you just take that monthly payment and multiply it by the total number of months in the term over the life of the loan. Will show you what the total principal and interest is for each loan. Now you just subtract from it the amount you borrowed, and that'll give you the interest. And then you subtract the comparison, the interest paid for each loan, to find out what the savings would be. Don't worry, we'll come up with this one again. This slide will come up again. But if you want, you can snap a picture of it, but it'll come up again. So which one saves you more money? Getting a lower interest rate or buying the property at a lower price?
Buying a property at lower price.
Okay, let's find out here.
Yeah, hey Seth, I want to ask you something about the housing market. My wife and I are looking to buy a new home. I've read that the housing market is in a recession, and that maybe, and I've been told by various people, hey, no, hold off, don't buy right now, that prices may be inflated. Is the housing market in a recession? Is now not a good time to buy, or is it? Or is it? I don't know.
It's a broader question, John, and a lot of it depends on where in the country you are. What we tell people all the time is what you want to make sure you're not doing is overbuying house. If you're looking at your interest rate right now, and to Dan's point, that inflation is what's causing interest rates to go up because the Fed's trying to get that under control. So you've got this compounding issue in the housing market. The problem you got, I would say the one thing you want to focus on is you can refinance interest rates. You can't refinance principal. Principal, whatever you pay for that house is what you bought that house at. Now, in certain pockets, maybe where you are in Miami, where I am in Texas, not where Dan is up in New Jersey, I think in our neck of the woods, prices are going to stabilize. They may not go up as fast, but I think they'll still continue to go up, maybe not even drop. If you're in a cash position, that's great. If you're up where Dan is, I think they're going to drop. So you might have a buying opportunity, but where we are, I think you might want to, if you find the right deal, get it, but plan to refinance as soon as interest rates do drop.
Yeah, Dan, I don't know where you are, but I read recently that Jersey City has now become the most expensive city in America. I used to live in Jersey City, and boy, I wish I would have bought when I lived there way back 15 years ago, whenever it was. Seth Benson and Dan Geltrude, I appreciate you guys coming on for Money Huddle. Appreciate it. Have a good day.
So there you go. You could always refinance your interest rates, but you cannot refinance the purchase price. So you're better off buying a house for the lower price. The interest rates don't really matter. You could if you get a house at a good price and you get it at a higher interest rate, that's fine. You could always refinance it later to get a lower interest rate. But whatever amount you purchased the property for, that's it. You can't renegotiate that later. You still got to pay that amount back. So that's the best way to get the most savings. So there you go, Sanchita. You were right. You buy a cheaper house, right? Okay, so here shows you this screenshot from your book shows you a chart. The dark, each bar is 1 year in your mortgage loan, and the dark color part of the bar is the interest, and the light color all the way here at the tippy top, you see that little light color part? That is how much goes towards paying down your interest, the amount you borrowed. So for the first half of a 30-year mortgage, the majority of your mortgage payment gets applied where first? It gets applied towards the interest. And then that starts to flip the other way about halfway through. And we already discussed the reasons behind that. Why? Because on average, most people stay in their homes for 5 to 7 years these days. They don't, it's not like your parents or your grandparents that they were more stable, that they lived in that house, they raised generations of family in that household. These days you get people that they don't need to live near the place that they work, so they tend to move more often. You also have you don't have what we call, I don't call it this. Some politicians call it the nuclear family. That's where you have a mother and a father present. Usually those families tend to be more stable. You've got the income of two parents usually, or they just tend to be more stable and they don't move as often. When you have more single parent families, or seniors, or that are living on their own, or you're having the single head of household people, they tend to move more. There's nothing really holding them down. So it's societal changes that are causing this. But as long as we are aware of what the causes are, then we could see, who's more likely to move. And then maybe that could be helpful for you in your real estate careers and businesses, and who you target for selling houses or buying houses more often, right? Okay, let's look at the anatomy of an adjustable rate mortgage now. With an adjustable rate mortgage, or an ARM for short, that's what we call them. ARMs are adjustable rate mortgages. They shift the risk or reward of the fluctuating interest rates from the lender to the borrower. Now, people say you don't want to get those loans because you never know what the interest rate's going to be. It's always going up and down. Well, interest rates do always go up and down, but not once you got the loan. The loan usually adjusts only once on the anniversary of the loan each year. So then that whole year, that's what the interest rate is that you're paying. So the rates are adjusted once per year on the anniversary of the loan. Now, what determines if the rates go up or down on an adjustable rate mortgage? Well, it's usually tied to some sort of an index. And a common index used is the 1-year US Treasury bill. You see if the rates on those go up or down will dictate if they go up or down on your adjustable rate mortgage, or some other index that the lender may be using. Now, margin is how much the lender wants to make off of you. There's a cost to the money for them to lend to you. So for instance, if it costs them 2% to borrow the money that they're going to lend to you, how much they got to charge you if they want to make 2%? They got to charge you 4%.
At
That's
least
the
four.
Yeah, that's the margin. That's the markup. Now, the cap is the maximum that the rate can go up each adjustment period. So that the cap is the maximum the interest rate can go up at any single adjustment period, which is once a year. And the ceiling is the maximum that the rate can go up over the entire life of the loan. It's like a lifetime cap. So when you get a loan, they're able to give you the worst case scenario. If the ceiling were reached over the life of this loan, what is the worst case scenario that maximum that your monthly mortgage payment could be? They spell that out to the borrower before they sign the loan documents. As a matter of fact, they need to sign on a page that shows you this with a font size about that big. So it's not like you didn't see the numbers, it's a huge font size, to make sure you're not just like, it's the lender's fault. I never knew how much they could go up. Sure you did. You get adjustable rate mortgages because of those teaser rates where you could initially get into them at a really low payment. You just got to realize that once those rates start adjusting, because they're fixed for that initial period, when they start adjusting, they go up to whatever the market rates are, up or down. Okay. And if they're going up, but you were already fully maxed out on what you could afford at that fixed teaser rate, oof, you should have already gotten out of that property or refinanced to a conventional loan or a fixed rate loan. If you don't, if you're just gambling that the property values keep going up, so you're going to get more equity in it and you'll be able to have an easier time refinancing, isn't that gambling? Hoping that the prices of homes continue going up and up and up. Yeah, that's gambling. So some people did that. They went out and they rushed out. They got these adjustable rate mortgages, cheaper way to get into house. And then they were like, I'll just refinance and do a fixed rate loan once I get enough equity as prices keep going up. Okay, what happens if prices stop going up? And what happens if they even start falling? Oops, that gamble did not work out for you then. Because who's going to give you a loan? Because what is refinancing? Refinancing is getting a new loan that pays off the existing one. So if you're going to get planning on refinancing into a fixed rate loan, who's going to give you a loan to pay off your existing loan when your house is not worth what you owe on it? Oh, so if the values drop like that and your home value is now worth less than what you owe on your current loan, you're not going to be able to get a loan to refinance. And this is what happened when the mortgage markets were crashing. This is not the reason for it, adjustable rate mortgages. They're a contributing factor to it, but it's not the only one. The markets were already crashing when before adjustable rate mortgages became adjustable for a lot of these people. Okay. So let's highlight that ARMs adjust, they shift the risk or reward of changing interest rates from the lender to the borrower. Interest rates go up, they pay more. Interest rates go down, they pay more. No skin off the lender's back. So it shifts that risk or reward from the lender to the borrower. As I explained a minute ago, a lot of people blame the real estate mortgage market for the crash of 2006 on adjustable rate mortgages. However, there was a lot more to it than that. Have you guys seen the movie The Big Short? If you haven't, check it out. The Big Short is a movie about the mortgage market's crash that we had. It's a star-packed, celebrity-packed movie, but it goes over a lot of people's heads. But if you're taking a real estate class, you're gonna get it all. It'll make a lot more sense to you The Big Short does a pretty decent job explaining what happened, taking the politics out of it. But unfortunately, the politics was a major contributor to why our mortgage markets crashed. Uh, so it doesn't completely cover all the political decisions and House oversight of the banking industry by the regulators and the political decisions made by politicians over the years that allowed reckless lending practices and even encouraged them under the guise of writing more loans to poor people and minorities, which then later on came to be known as predatory lending. So the politicians were actually threatening the banks that they should be doing predatory lending. But the reasoning was better. It doesn't sound predatory when you say you need to start writing more loans to poor people and minorities. Otherwise, we're going to start thinking that you are discriminating against them, and that's why you're not giving them loans. So banks got told that they're going to start getting huge fines or even get their banking licenses revoked if they don't start writing more loans to poor people and minorities. Even though the banking regulators were explaining to this oversight politician on the Congressional Oversight Committee for the bankers, the regulators, the investigators, they were the ones that were explaining to the politicians, well, that's not the way it works. Lenders don't look at your race, or they do look at your income, and they look at your debt to income. They analyze risk. That's why it's called risk-based lending. How much money you put down, what's your credit scores like, these various factors, what your income is in relation to your monthly debt, payments. These are the things they look at. And the politician was like, I don't want to hear any of that. If you don't start writing more loans to poor people and minorities, then we're going to start fining the lenders and maybe even consider yanking their licenses. So the banks were like, say what? Okay, we hear you loud and clear. More loans to poor people and minorities. Okay, so how do you write more loans to minorities? I mean, you're targeting a specific group of people. How do you write more loans? It's not like you could drag people into the bank, right? Well, you got to flood them with all kinds of advertisements and stuff in maybe the different channels or programs that they watch on TV, or in the neighborhoods with high minority populations. Shower them with billboards, and in the magazines and the websites and everything. That's where you got to target their advertising so that they see more that you're trying to give them these loans. And then if you target them enough, maybe they'll be enticed to come in and buy. Now, what about the poor people? I mean, poor people know what they can afford and what they can't. So how do you get more poor people loans? You lower the lending standards, silly. So if you lower the lending standards, then they could maybe afford to get a loan. But let me ask you a question. If you lower the lending standards for poor people, what about the people who could already afford to get the loan? Doesn't it make that more money available to them to borrow because you lowered the lending standard? Yes. And if people could borrow more money, what do you think that property owners are going to want for their property? Mo money, right? That's common sense, right? So this was what led to this, a huge part of what led to this mortgage meltdown was these politicians, let's just say well-meaning intentions for his threats to the banks. But it was all based on race and uh, and for targeting the poor people. That was just a dumb move because the regulators were saying you're going to have a lot more people defaulting on loans. You're going to be enticing people in that are already struggling to be able to get these loans, and then they're going to have a tougher time. You're going to have a lot of people you're going to pull into default. He didn't care. He was like, we need more loans for poor people and minorities to let them have the American dream of home ownership. Okay. So the banks did that. And then when they targeted people based on their race, later on, when they started getting foreclosed on because they were getting adjustable rate mortgages, perhaps, and then hoping that they would then refinance them to fixed rate mortgages. Then all of a sudden it became a negative thing. The banks were targeting us. Yeah, they were targeting us because they were told to. This is predatory lending. This is predatory behavior. Okay, you're making it sound bad now, calling us predators, the banks, for lending that money. But that's what they were told to do, So there's a lot more to what led to the mortgage market meltdown than meets the eye. And I just gave you like the major part of it. It did stem from politicians butting their nose in and making changes and tweaks in their arrogance, thinking that they could, I don't know, what they're in their arrogance trying to get more people into housing. That if they didn't want to get there themselves, they figured they could force them into it by enticing them into home ownership. Poor people and minorities by targeting them. But I mean, it sounds good when he said that he just wants to get more people to have the dream, but then, when they start getting foreclosed on or whatever, now all of a sudden it's predatory and it's evil, So make up your mind. But either way, you guys can watch that movie probably for free. I know you can watch it for free on like Tubi TV and Netflix and such. It's called The Big Short. It goes over a lot of it. It's kind of entertaining too. Let me see. Here's what it looks like. The Big Short, 2015 film. You got a lot of big celebrities in there. Christian Bale, Steve Carell, Ryan Gosling, Brad Pitt, amongst a lot of others. It goes on and on and on. Marissa Tomei. All right. Now they talk about in 2008. Well, the mortgage market meltdown actually started in 2006, and it started going down, but it really picked up speed in 2008 with its crashing. But it's interesting because this movie is about a group of investors that do shorting of the real estate, shorting of the stock markets. So basically, what a short call is if you're investing in stocks, normally you buy low and you sell high. But you could buy stocks and invest in stocks hoping that they fail. So if their values drop, you actually earn money. If they go up, you don't. These guys were betting on the real estate market tanking and the lending tanking, and they're like, they hired this guy. What's his name? The one from The Office. They hired him to because he was an analyst to look at these things, and he's like, oh, that's never going to happen because there's so many security mechanisms in place that the banking industry would never be allowed to crash. You've got the Department of Banking and Insurance, you have this, you have that, you have a central banking system, you have all of these warnings and triggers in place that would prevent this from ever happening at a massive level. And then this shows you how, because of little tweaks that politicians made to get in favor with poor people or minority groups or what have you, that because of their actions, they started removing some of these protective mechanisms, and that ended up leading to the markets crashing. Okay. And it was all because of their well-meaning intentions. Okay. We know what the road to hell is paved with, right? The best of intentions. So Watch the movie, give it a look. It's worth it. So here, once again, is the anatomy of the adjustable rate mortgage. The cap is the maximum the interest rate can go up in any single adjustment period. And the ceiling is it's like a lifetime cap, the maximum that the interest rate can go up over the entire life of the loan. I would say one way to remember that is, got a bottle of water in my garbage can here. Okay, let's just pretend that this is a bottle of soda. Okay, and I shake it up. What's preventing it from blowing out and going as high as it wants to?
The cap.
The cap. Okay, now if I do take off that cap, it's going to go spraying. But what limits how high it could go now?
The ceiling.
So the ceiling is higher than the cap. This is just a way for you to remember, the cap is the maximum in any single adjustment period. You take off the cap, the ceiling is going to stop you overall. So the ceiling is always higher than the cap. Okay. Give you a little visualization there, a way to remember the difference between the ceiling and the cap. There we go. All righty. So the cap is the maximum the interest rate can go up in any single adjustment period. The ceiling, sometimes called the lifetime cap, is the maximum allowable interest over the life of the loan.
Oh, okay. So, all right. That's what it is. The cap is a one payment.
Well, in any single adjustment period, which is 1 year. The interest rate in adjustable rates mortgages gets adjusted once a year. Okay. So if the interest rates go up, how much can they go up in that for that 1 year? That's the cap that limits how much it could go up in 1 year.
Okay. And then the ceiling
Is the maximum
go up over the entirety of the loan.
Correct. So if you got a 30-year mortgage, all those increment payments, if the interest rates keep going up year after year, they keep going to the cap every year. There is a maximum how high that interest rate's allowed to go over the life of the loan.
Okay.
That would be the ceiling.
Got it.
Okay.
Yep.
So we went over amortization. We went over straight loan. We went over partially amortized loans. Now we're going to talk about something called negative amortization, because this sometimes comes up with adjustable rate mortgages. Usually when they give you a teaser period where the interest rate is lower than what you could get in the open market to try to get you to get into that loan. During that term, the loan is usually negatively amortizing. Amortize means to kill off over slowly over time. Negative amortization means that the opposite is happening. You are not killing it off, but you're building up debt. So every month you make a payment, you owe more money. Now, how could that happen? Well, that could happen if your monthly payment isn't enough to cover the interest. Now, on adjustable rate mortgages, they do this on purpose. They set it up as a teaser at the beginning, so the lender eats the loss. The borrower does not eat that loss in the beginning of an adjustable rate mortgage. But there are some other loans out there that could end up in negative amortization territory. And that's when they have these types of loans where they give you the option to pick a payment. Where you make a monthly payment, you could either make your regular monthly mortgage payment, pay a little more towards the principal, or pay less than you normally do. maybe pay interest only or less than interest only. Because maybe, hey, this month payments are a little tight, money's a little tight. We had some unexpected bills for other things, our car insurance, little Jimmy broke his arm, something like that. So we have less money available, so we're going to make a lesser payment. But when you give people the option of making a lower payment, they usually select the lower payment amount. And the problem with that is if they keep doing that, they could their loan is negatively amortizing. And every month you make a payment, you owe more money. Yikes. So all right. So negative amortization, let's highlight on page 270, when the monthly payment isn't enough to cover the interest due. That shortfall is added to the overall principal balance, and now you're paying interest on your unpaid interest. And that's not a good situation. Yeah.
Wow.
We have hybrid mortgage plans. These are ones that are those teaser rate, fixed rate for 1, 3, 5, or even 7 years. That the loan can be fixed, and then it starts becoming adjustable after that. Okay, these are known as hybrid mortgages because it's a combination of a fixed rate and an adjustable rate loan. Straight loan is an interest-only loan. So on page 271, let's write that next to the title. Interest-only loans, straight loan, short term. Used by builders, flippers, and as bridge loans. These are meant for short-term periods.
The above definitions are not important. Should we
Which one?
skip that?
What about?
Convertibility, initial interest rate, rate lock, assumalty, hybrid mortgage loans.
Well, we just spoke about the
The
hybrid.
hybrid, yeah, we spoke
Okay.
about that. Yeah.
Right now, they got a little, they added in just a little bit of a blurb about a rate lock. But what does it say there about a rate lock? I know the next slide I'm going to have something about rate locks, but
Okay.
what does it say right there in the book? I don't have my book in front of me. I got it off to the side over
A, a rate lock is a guarantee by the lender to issue the loan at the quoted interest rate as an incentive to the borrower. Under
Yep.
some conditions, the rate can still change.
Yep. Okay. So where is it? Okay, I got it coming up in 2 slides. Okay. So here's the next slide. Interest. Let's go over this first, and then we'll talk about the rate locks.
Mhm.
Interest is the charge. That's the rent for using someone else's money for borrowing. Interest is calculated annually on an annual basis. So if you borrow $100,000 and you get it at a 7% interest rate, it's 100,000, the amount borrowed, times it by the interest rate, and that'll give you the annual interest. You divide that by 12, the number of mortgage payments there are in that year, and that'll tell you how much of your first of that first month's payment goes towards interest. That's how you calculate it. You take the interest rate, times it by the amount borrowed, divide that by 12. That gives you that first month's interest rate payment. Okay, so we'll do the math on it. I'll show you this in a couple examples. But that's what I mean by interest is calculated annually. Now, an amortization schedule is a chart that shows you at any given payment period within the term of the loan, what the payment is, how much is left on the balance, how much is getting applied towards the principal, how much is getting applied towards the interest. That's called an amortization schedule. And on one of the coming pages, we'll see there's actually a chart that shows you an amortization, the first 3 months and the last 3 months of a amortization schedule. The point, sometimes called discount points, uh, is when you pay interest in advance to get a lower interest rate on your loan. You could pay that interest in advance. But the thing is, if you have, never do that. If you have the extra money, you're better off using it to pay down the principal. And that's less money that they could charge you interest on to begin with. So if you have that kind of extra money, doing those buy downs, trying to purchase a lower interest rate, you're better off using that money to just make a payment towards the principal. That's less of a balance they could charge you interest on for the remainder of the life of the loan. It saves you more money doing that. Okay, but sometimes borrowers have to pay points just to qualify for the loan because maybe their debt to income ratio is a little bit out of whack of what the lender finds acceptable to give you a loan. So they may require you to pay points just to qualify for the loan. Forget about getting lower interest rate. So points that are paid in advance, it's basically prepaid interest. And that is tax deductible by the borrower in the year it is paid. Each point is equal to 1% of the loan amount, not the purchase price, but the loan amount. We're talking about loans here. And it may be paid by either the buyer or the seller in their negotiations. But who can deduct it on their taxes? Only the borrower, because it is the borrower's loan. They're going to get the interest statement at the end of the year. So even if you manage to get the seller to pay interest in your negotiations on the borrower's loan, the borrower is the one that gets to write it off on their taxes. Okay, so it's tax deductible by the borrower in the year it is paid, no matter who paid it. And a rate lock, the lender locks in a rate. So even if the rates rise, the borrower gets the lower locked in interest rate. And they typically give you a complimentary rate lock for 30, 45, or 60 days. And if you don't close on time, the rates could go up. But the borrower can purchase an extension on the rate lock for an additional fee. We should try to avoid that and try to close on time so that we could save our clients money. So sometimes our clients don't realize we are doing that for them because remember, what's the best way I told you to be a good agent? Educate your clients. Let them know what you're doing and why you're doing it. What is this form I'm sticking in front of you to sign? Why am I always pushing you and pushing you to get things done? Some borrowers think, these home buyers, they think that my agent was so pushy, they kept pushing me through the whole transaction. I think they just wanted to get their commission. That's the impression they get. But if you were to explain to them, hey, listen, during this transaction, it may seem like I'm pushing you to get things done. Get this, get that. I am. And the reason why I'll be doing this to you is not because I'm in a hurry to get paid my commission. It's because you're getting a loan, and you got a loan probably by shopping around to get the best interest rate you could. And now you got it locked in. You only have it locked in for a certain period of time. So we need to get to the closing table before that time period expires. Otherwise, your interest rate may go up. So we're trying to beat the time clock here. And that's why I'm pushing you and pushing you. I'm trying to save you money from having to buy an extension to keep that rate locked in at that good interest rate that you managed to find. Okay, that's how you explain it to them. I'm saving you money, basically. It's not because I'm in a hurry to get paid. I want to save you money. And to save you money, we need to close on time. Okay? But if you don't explain that to them, my agent kept pushing me and pushing me. They wanted this, they wanted that. I think they just wanted to get paid their commission in a hurry. That's the impression that's gotten by them. Okay? All right. So you guys highlight interest is a charge for the use of someone else's money. It's the rent that you pay. So we need to know what a rate lock is. We need to know how to calculate a point, and we need to know who can deduct it on their taxes, the borrower. We need to know what an amortization schedule is and how interest is calculated on an annual basis. But we're going to do some math on that right after we have this one slide about rate locks. Now, this is from a previous version book, not this current book. Because interest rates change constantly, lenders may offer borrowers the opportunity to lock in a quoted rate. In this situation, the lender agrees to hold the quoted rate for a certain period of time. If interest rates go up, the borrower is protected. Unfortunately, if the interest rates go down, the borrower often cannot take advantage. Borrowers typically can lock in the rate for 30, 45, or 60 days and hope they get to closing before the rate lock expires. So I just gave you the explanation to give to them why you're trying to rush them along to try to beat that rate lock expiration. Okay. The current version of in this current version book, the explanation of a rate lock is not as thorough. It just says you lock in the interest rate at the quoted rate, and in some circumstances it could go up. Okay, so this one's a little bit better of a definition. Now, even though they say, unfortunately, if the interest rates go down, the borrower can't take advantage. Oh, sure they can. They could threaten to go get a loan at a different bank. and then look how accommodating they'll suddenly become and willing to lower the interest rate. Something called leverage. I don't have to get this loan with you. I could cancel it with you. Sure, it's going to extend my transaction maybe, but at least I'll get the loan through someone else that's at a lower interest rate.
We did it twice or thrice in India, and
Yeah.
So they automatically reduce the interest rate.
Of course they will.
Yeah.
You know, they'll try to play chicken with you. Oh, we don't do that. You can't do that if the interest rates go down. Oh, so then what you're telling me is I need to go to a different lender to get a loan at that lower interest rate and drop this transaction with you right now. That's what you're telling me? Well, let me speak to my supervisor. Yeah, that's the kind of reply you're going to get. Okay, you got to be willing to play hardball, but this is not us. This is our client. So you got to tell your client they got to be willing to play hardball, you know, but also be aware of the outcome. You know, they may just play chicken with you a little bit longer and see if you go to somewhere else. So you have to be ready to drop that deal or drop that mortgage loan that you've already put all the paperwork in for and did the appraisal for and all that, to take it over to a different lender and start all over again, that lending process. You know, but you already got all your information, paperwork gathered, so it should be a lot easier and quicker to be able to do it because you already know what the next lender is going to want. Okay. So that's all a part of the art of war, right? Don't make threats that you're not willing to follow through with. Robert Kiyosaki, Rich Dad, Poor Dad, author for that. Donald Trump, The Art of the Deal. These books will often tell you the same kind of things. In negotiations, you're not going to get the best deal unless you're willing to walk away from it. So that's a risk that you need to take, though. Okay. But as far as we're not the ones taking the risk, that would be our clients. So we just need to educate our clients on that. Anyway, moving on. So interest is the charge, the rent for using or borrowing someone else's money. And like I said, it's calculated on an annual basis. And here's the formula for calculating that interest. You take the loan amount times the interest rate, that'll give you the annual interest. Divide it by 12, and that'll give you the monthly interest payments. and subtract that from the total mortgage payment amount, that monthly mortgage payment amount, and it'll show you how much of that first month's mortgage payment went towards the principal. Okay. So PI, that's your principal and interest. That's your mortgage loan payment, consists of principal and interest. Subtract the interest from the principal and interest, and you're left with the principal. Okay, PI minus I equals P. I just need you to know these formulas because you can use calculators on exam. So I'm not sweating the math part if you know how to do math. Okay, I suck at math, but I know how to use the hell out of a calculator. And if I could remember the formulas, you're on. You're good. So don't sweat it. Okay. So how to calculate monthly payments towards the principal. That's how you do it. Here's an example in the book. Put a highlighted box around it. This is page 272 in your book. You guys see this chart? And I wrote above it, calculating interest and amortization annually. Okay. You're calculating the PI part of pity. Not all mortgage payments include taxes and insurance. The payment itself for the loan consists of PI, principal and interest. And that's what we're talking about here. So how do you figure out how much of your monthly mortgage payment goes towards the principal? Well, first you need to calculate the interest so that you could then subtract it from the monthly payment, the principal and the interest, to figure out what the principal, how much went towards the principal. So in this example, $100,000 you borrowed, times it by the interest rate of 7%, that's $7,000 annual interest. Divided by 12, that means your first month's interest payment is $583.33. So if your monthly mortgage payment is $665.31, subtract $583.33 from it, and that means $81.97 went towards paying down your principal. That's the amount you borrow. Now, to find out how much will go towards your next month's payment, you start that math process all over again. But first you have to subtract the principal that you paid down from the 100,000. That means your remaining balance is $99,918.03. So now you take that amount, times it by 7%, divide it by 12. And if you do this over and over, if it's a 30-year mortgage and you do that 360 times, you now have an amortization chart. That's how they come up. That's how they make amortization charts. That's all it is. We're just doing that math problem over and over again. And you could have an Excel file build it like that for you, with that formula. It'll do it instantly. And now you can see any time within your lending period, your terms of your loan, how much you paid down the interest, how much you paid down the principal at any given point, and what the loan balance is. There's also a calculator that you could get for free. You could also pay for advanced features if you need to, but there's a calculator you could get for free. Let me open up my real estate apps on my cell phone. I got a bunch of real estate apps over there. I could share with you what some of them are. RPR, you can look that up, Real Property Resource. That you get for free with your NAR membership. But the calculator I was talking about, something called Carl's Mortgage Calculator, KARLS, Carl's Mortgage Calculator. It's more than just a calculator. It could figure out different types of loans, and it could create amortization schedules. It could compare loans. Well, comparing loans, I think that's an advanced feature. So you would have to pay the $3 for the calculator, or whatever it is. But it could do some pretty advanced stuff. You could plug in the property value, the down payment amount, the principal, the interest rate, and the term of the loan. And it'll tell you what your monthly payment is without you even having to do any math.
Carols, Karols.
KARL''S.
Cards. Okay.
Carl's Mortgage Calculator. And so you plug in the numbers and it gives you that information,
Okay.
And then it could create tables for you, showing you what all the payments are, how much went towards the interest, what the LTV is, You could have graphs. It could create fancy graphs for you. Charts, or they could summarize it up there in a summary for you. Really good. I know it's kind of
So these
blurry.
are available on
That's
iPhone
all. Yeah, it's available on Android and
App
iPhone.
Store. Yeah.
Mhm. Okay. All right. So
You said we have to be a member of NAR before we could get access to them, though?
no, the RPR app, the Real Property Resource, that one you need to be a member of. Carl's Mortgage Calculator, you could download it right now. It's free. They got a paid version too for some advanced features, but it's free. The paid version is only like $3 anyway. Like some apps, like I have for my real estate apps, I have something called Photo FY, Photo. We get that for free, I think, with that All Jersey MLS. You get your Super E key to get access to the digital lock boxes. Remember, I showed you guys the lock boxes and how to use them. Adobe Scan. So it scans all kinds of documents into a PDF. I got your regular calculator that's on your phone too. I threw that in there too, because you're going to need that a lot. Showing Time is an app you probably need for setting up showing appointments. A lot of agencies use it. So you can set up a profile for yourself, even if you don't subscribe to it. It makes it easier to set up showings and whatnot. Supra Home Tour, that's an advanced thing for the Supra key. You could set that up for keeping track of all the properties you showed to specific clients and stuff. You could keep track of that. I have something called the King Compass. I previously had a different one on here, but this one's pretty good too. It's good for both that Feng Shui and Vastu, but there's other ones out. There's many of them out there, but the current one I have installed here is King Compass. I like its simplicity. Let's see. Of course, now it has to update. Okay, there we go. It's just a basic compass there. Tells you exactly where you are and everything. Make sure you go like this with your cell phones to reset the compass when you're reading it and have it level. Okay. What other apps do I got in here to share with you? I got Flex MLS Pro. It's for one of the MLSs. All Jersey MLS. They use Home Spotter. I got the NAR app, the Remine, Remine, Remine. Kubicasa, we get that for free with our All Jersey MLS. It's basically you open it up and you walk around the perimeter of the wall in the house and the whole house, and it creates a floor plan for you. Okay.
What's the name? How you spell that?
Kubicasa, Cubicasa. Kubicasa. But you'll be using the link to get that one to set it up from the MLS. Let me see. Forewarn, Forewarn. You get that for free with the Realtors Association. And then you got your Zip Forms Mobile. You can use that as well. Now, let me throw out the morning attendance poll for you. I don't think I threw that out yet. And my coffee's running through me. So while you guys answer that, I'm going to run down to the bathroom real quick. If you guys need to get a coffee, drink, or something, do it really quick. I'm just going to the bathroom, coming right back up. Okay. I'll be right back. All right. So this is how we calculate interest and figuring out how much of your monthly mortgage payment goes towards the principal. if they gave you that kind of a problem, which they may. Not on school exam, but probably on state. We don't have these problems in there yet. And here is the first 3 months and the last 3 months of a mortgage amortization chart. It shows you on a 30-year fixed rate mortgage, the payment, the first payment all the way through the last, all 360 payments remain the same. Nothing changes when we're just talking about the loan. You know, I know a lot of people, they have their property taxes and homeowners insurance included in the loan, and then your payments could fluctuate based on if your taxes or your insurance rates go up. But if it's just the loan itself, a fixed rate mortgage, first payment through to the last remains the same. It just differs in how much gets applied towards the interest and towards the principal. You see, towards the end of the loan, that flips where more money gets applied towards the principal than the interest. Okay. By the way, this you may want to correct this on the amortization chart. That number is wrong. Change the 3 to an 8. That should be an 8.86 cents there. And I know this is a 30-year loan because there's 360 payments, 360 months. And I know it's fully amortizing because the balance is 0 when you made the last payment, which remained the same. Here's a mortgage factor chart on page 273. I want you to write that above it, mortgage factor chart. Highlight it and write mortgage factor chart above it. And then above that, there are instructions on how to use this chart. I have instructions here on the side as well. It's basically, this is the way that you read this chart. There's 10, 15, 20, 25, and 30-year term loans here. Now, you could get loans for less than that, and you could get loans for more than 30 years. So these are the most common ones, though. Excuse me. So this is how it works. If you had a 5% interest rate and a 30-year loan, you put your finger where it says rate and run it down to the 5. Now run it across to the column that reads 30 years. 30 years, that's 5.37. Everybody get that? Okay, now you, congratulations, you now know how to read a mortgage factor chart. Was that simple or what? Okay, so tell me, what would be the factor at a 4.5% interest rate for 25 years loan? 4.5% interest for
5.56.
5.56. Very good. So you just ran your finger down to 4.5%, went across to the 25-year term, and you got 5.56. So that is the mortgage factor. Okay, now let's clarify. What is a mortgage factor? For every $1,000 that you borrow, your monthly mortgage payment, including both your principal and the interest, is $5.56. So if you borrowed $300,000 and your factor was $5.56, what would your mortgage payment be? You borrowed $300,000. And the factor is 5.56. What is your monthly mortgage payment?
Okay, I need you to do the what you call it again.
16,680.
1668. Okay, so this is what you do. You run your finger down the column to 4.5% and to the 25-year column. The factor is 5.56. That's for every $1,000 you borrow, your mortgage payment is $5.56 per $1,000. So if you're borrowing 300,000, how many thousands are there? 300.
300.
So 300.
Now this
times,
is now, okay, I got a question. This is the standard for every
No,
loan?
different lenders may have a different chart, but this will get you in the ballpark.
No, not the chart. I mean the rate. So the rate, that number 556, is that a number that I should remember? Is that
Well,
across
that's
the board for
no,
every thousand? Or
no,
is
you're
that
not going to,
based on the interest rate?
no, you're not going to be member. It's based on the interest rate and the term. This is how you figure out what your monthly mortgage payment is going to be.
Oh, okay.
That's what the factor chart does. So you run your finger down to the rate, whatever rate you get approved for. Okay.
Okay.
You run your finger down here. If you got approved for a 4.5% interest rate for 30 years, your factor is 5.07. So
Okay.
that's called the factor. The mortgage factor is 5.07, which
Okay.
basically is $5.07 for every $1,000 you borrow. So if you
Okay.
borrow, so if you borrow well, the question that I just gave everybody was based on a 25-year loan at 4.5%. So the factor was 5.56.
So I didn't hear all the variables. That's why I
So
was lost. I'm
okay,
sorry.
well, I have it also written here on the side with these instructions on the side so that you could figure it out if you ever forget.
Okay.
Now, and in the book, it's at the top of the page. There's an explanation at the top of the page on this page with the factor chart as well. So basically, if we borrowed $300,000, you take 300 because that's how many thousands there are, times it by the factor of 5.56, and you get $1,668.
Okay.
That is your mortgage payment monthly, including that's just for the loan. That's not including property taxes and homeowners insurance. This is just for the mortgage loan. Okay. I know sometimes lenders they want to entice you to include the taxes and the homeowners insurance in there to make sure those important bills are being paid. So write down 1668 on the side somewhere. 1668. Because that was your monthly mortgage payment with the 4.5% interest rate at 25 years. What is your average property tax in New Jersey? Anybody know?
6 to 7%.
No, your average property tax.
Oh, I don't
Do
know.
you know how much money the average person pays in property taxes? I mean, there's some people pay a lot of money, some people pay little, but on average, do you know what the average property taxes are here in New Jersey?
No.
Take a guess. Take a wild guess. What would you guess the average to be?
12%?
No, it's not a
Six.
percent. It's a dollar figure I'm looking for.
Oh, dollar.
Oh, per
Um,
quarter or per year you're asking?
Annually, what's the annual property taxes? That's the average. Like if you factor in the people that pay a lot, people that pay a little, what is the average property tax bill in New Jersey?
About
four, four,
10,000.
4 to 5,000.
Oh no.
10,000.
Okay, you're a lot
Oh,
closer. Yeah, it's about $9,700 a year now.
Yeah, 10,000. Yeah.
That's a lot of money. New Jersey is one of the highest tax states in the nation.
Annually 10,000.
Yeah.
Okay.
So $9,700 being the average. And let's just say you pay $800 a year for homeowners insurance. So let's add $9,700 plus the $800 a year in homeowners insurance. That gives you a grand total of $10,500 for taxes and insurance. Divide that by 12. That gives you an additional $875 on your monthly mortgage payment. So if your 25-year mortgage at a 4.5% interest rate was 1668, add that 875 plus the 1668, and now your mortgage loan payment monthly is $2,543. That's how we figure out what your monthly mortgage payment is. Taxes make a big impact on how much you could afford, how much house you could afford based on your monthly payment. Yes, they do. That's a big extra amount of money to pay every month, an additional $800 and change, you know, additionally just in for property taxes and homeowners insurance.
So when we moved here, people suggested us to buy a home because the rent we are paying, they said that you can buy a house and pay the interest with that. I
It
mean,
depends on the market at any given point in time. It may be more advantageous for you to purchase a house and make a mortgage payment. Sometimes the mortgage loan payments are about the same as the rental payment. And if that's the case, it makes more sense to own than it does to rent. Because remember, property values fluctuate. They could go up as well over time. And they go, even though they fluctuate, they go up and down. Over the long term, they generally go up. So
so
real estate has
so if you're
historically been a
saying
good
if
investment.
so if you're saying it is 10,000 annual, so in that case we are paying almost double the rent. So in that case we should buy a house, you're saying? I mean we are paying around 2,600,
According to this, yeah. Well, this is for based on a $300,000 loan. You know,
300,000. Okay.
real estate real estate values have gone up
Up.
tremendously. You
Yes.
know, and a lot of it had to deal. Listen, we're actually still kind of in a recovery. You know that you have to look at politics. Unfortunately, I hate politics. It's a dirty thing, but you got to look at it. Politics plays a huge role in real estate and real estate costs. You know, during the during the Biden administration, the costs of a lot of things went up, and that was mainly because of fuel costs. But there was also all kinds of environmental regulations and all kinds of other red tape nonsense that his administration created that just kept driving up costs. You know, every house needed to be green in some level. Yeah, this needed to be green and meet certain standards. This needed to meet. So these are all raising cost contributors. You know, and then now that stuff brings up the cost of a house. But what brings up the cost of a house more than anything? What single factor brings up the cost of real estate more than anything? How about this?
Maintenance?
How about this? What single factor brings up the cost of anything? It's common across no matter what it is that you're buying or selling. What is the one single factor that brings up the cost of anything?
Tax? Maintenance?
Supply and demand,
Okay.
right?
Mhm.
If you have a limited amount of a supply of a product, but it's in demand, um, the costs of it are going to go up,
Goes up.
whatever it is. All
Correct.
right. Now with real estate, you know, over the last, I don't know, 8 years or so, we've had, or even longer, we've had almost 20 million people enter our country, right? Where are they going? They got to live somewhere. There's a demand for housing. That increased demand for housing that we already had a housing shortage. So you have now entered 20 million more people into the country. that housing demand went up even more. So naturally, it's going to raise the costs of things. You know, even though you've got, ICE out there, deporting people, they're not doing it at any large rate as they were coming into the country. So I, they would have to deport so many people in order for that to bring the costs down. So I don't see our costs coming down for real estate from that factor um, in any huge way anytime soon. But fuel costs, fuel costs carry because lumber and every component that's used to build a house has to be shipped out somewhere. I'm not even talking about the energy or the cost of anything to build a product. I'm just talking about getting it shipped from the factory to the Home Depot where you buy the lumber or the lumber yard, um, uh, every component, the light plugs, the electrical wire, cost of all of this stuff has skyrocketed. Not just in this last year, it's been going up steadily for a while now. But these are all factors that contribute to the price of housing. So the price of housing in New Jersey shot up even more. And now you add on top of that, even though New Jersey is a very liberal state, we're a blue state, um, we have people fleeing from other blue states coming here. New York City, California, you know, even though a lot of those people they're fleeing, they're moving to Florida and Texas. We do have some that's coming to New Jersey. Uh, the actors industry, that acting industry, the movie industry, a lot of that's coming to New Jersey. You have the people in New York City. They advocate for certain political stances, but then they move out of town when they actually go into effect and they see the effects of cost rising and crime rising. When actors walk in the street and they get sucker punched, and then the person who punched them gets released. They get arrested and get released, and nothing, and charges drop. You know, do people want to raise their families around that? Do husbands want to trust their wives walking out on the street are not going to get accosted? What about their daughters, and such, uh, they you could believe in whatever your beliefs are, but you could see when uh, people's actions speak louder than words, and when they don't stay in the state, they actually leave that state. That speaks volumes. Now, a lot of them in New York City, they're just moving over the water to New Jersey. New Jersey's being very expensive, but our costs are still a lot cheaper than the city, New York City's cost to live, right? So what you pay for a house here, we think is very expensive here in New Jersey. Um, by comparison, in New York City, it's a drop in a bucket, you know? So they got no problem paying the higher fees. And as long as that demand is there and somebody's willing to pay it and has the money to, our costs ain't going down here in New Jersey. Okay. So real estate, have you ever heard the term real estate is local? You know, it's not, the cost of real estate is not based on national issues. It's more based on local demand, the supply and demand locally. And why is that happening? I mean, there are national issues that play a role in it, like the fuel costs and such like that. But otherwise, you have to look at it all as a whole. You know, there are, this is why I tell you to take those Ottawa classes teaching you how to value real estate. They also teach you about changes in the geographic region, which areas are expected to get more busy and which areas are expected to slow down and why. And once you start going to these classes and you start learning and these guys start explaining to you how this stuff affects prices, after a while you guys are going to be able to start to figure out some of this. When you're watching the news, you're going to be able to be like, oh, that's going to affect real estate in this way. You're going to start to change the way you think a little bit. um, you know I'm not talking about changing anybody's political beliefs or anything like that. I'm just talking about being aware of what affects real estate. Okay. That's the only reason why I talk about politics. I'm not trying to convert nobody here to any different parties or anything like that. I'm just trying to explain to you that politics does play a major role in real estate on many levels, especially at the local level. All right. So we know how to learn. We learned how to use this mortgage factor chart. Everybody wrote that at the top, that this is the mortgage factor chart, and that's what you know it as now. You got it highlighted, and it's based on per $1,000 borrowed. We're going to need this chart still, but we're going to move on to the next slide. I may have to adjust
So
this one a bit.
if we get any maths question on the exam, we will get this chart, or we will
Yes.
get the number.
On state exam, school exam, we don't have a question about it yet, but we will once I'm able to put that chart up there with the question. I think we have the ability to do that now. I just haven't gotten around to, redoing the exam there, or adding these questions to the database with the visuals. Okay, so there's a tax deduction loophole. This just shows you how politics plays a role. And on taxes, your tax deductions, and how to judge it based on the actions. So Trump attempted to end tax loopholes for the rich. Remember, people were always screaming about how Trump is always there to protect millionaires and billionaires and gazillionaires, his buddies on Wall Street. But then it's really his detractors that are the ones that are in bed with them. But take a look at his actions. Yeah, he's a rich guy. Yeah, he says he pays taxes. And yeah, he says he tries to get out of paying them as much as possible because he follows the laws that are available. And who wrote those laws? Congress did. So if they don't like the laws, change them. So what he did here is he attempted to do something that they accused him of being in bed with the rich and favoring the rich. So he put in here taxes that would affect the rich. Could you generally state that people who pay higher taxes normally are richer? I mean, if you got a mansion, are you paying more property taxes than somebody who doesn't have a mansion? Yeah, because it's based on the value of the property. Okay. So what would you consider would be a high tax in the country? Because remember, he's the president, he deals with the whole entire country. So what would be considered a high tax nationwide? So what he did is he set a tax limit that he thinks that anything above this amount, that would be, you'd probably be considered rich if you're paying that much in property taxes anywhere in most places in the country. Now, that is true. And however, that negatively impacts states with very high property taxes. And New Jersey is one of the highest tax states. So we got affected by that, where the Tax Cut and Job Acts affects went in place from 2018 to 2025 that allows homeowners to deduct interest on qualified home loans up to $750,000, down from $1 million in 2017. Is this how they still have it written in your book, by the way? I think this book came out in 2025, so I think this is from your book, right? That's the way it's currently written?
Yes.
Yeah, okay. So, which affects from 2018 to 2025, that allows homeowners to deduct interest on qualified home loans of up to $750,000. Now, in most regions in this country, if you're buying a $750,000 home, you're rich. Okay. Now, that's down from $1 million, which was the threshold in 2017. So Trump was like, hey, $1 million, you're rich, but you know what? 750, you're probably rich too. Most people can't afford a $750,000 house either. So that's for married taxpayers. So for taxpayers who use married filing separate status, that's okay. The home acquisition debt limit is $375,000 now. The new law ended the deduction for interest on home equity lines of credit in 2026 unless one condition is met. The home equity lines of credit are used to pay for improvements on the home, not to go on vacation or buy a new car or other luxury item that you're wasting it on. A lot of people use their homes as piggy banks. And then when their home values drop down, they say, my house ain't worth that no more. I ain't paying it. And then they default on their loans. This is another part that played a major effect in our mortgage markets crashing, was a lot of people were doing that. They were just doing cash out refis, taking the money out, investing it to buy more homes or cars or go on vacations instead of reinvesting it into their home. So he said you can't deduct it on your taxes unless you reinvest that money back into your house. Then you can. So he's just trying to get people to think more responsibly, you know. Now, the upper limit to state and local tax deduction, the SALT deduction, is now $40,000. He finally gave in. Basically, it was lower than that. Let me see what amount it was. I got to get to that slide. That was previously $10,000. However, he got reelected here and people were complaining. New Jersey's a higher tax state, so you're picking on New Jerseyans and those who live in liberal states because their taxes tend to be a lot higher. So you're picking on a political party. So he's like, all right, how about this? How about if I raise it to $40,000? I mean, $10,000, isn't that considered a high property tax? We saw $9,700 brings up your, how much? Here, let's just look at $10,000. If you have $10,000 that you pay in property taxes, divide that by 12, that's an additional $833 expense, okay? That seems like a lot. But apparently, the politicians in New Jersey and other states, they're like, he's picking on us because we kill our own constituents with high taxes. He shouldn't be allowed to do that, even though that glaringly points out how you're being overtaxed because most states aren't taxed that much. So he said, all right, screw it. Let's raise it to 40,000. Tax your citizens away to oblivion. Now you could get the upper tax, the SALT tax deduction up to $40,000 in property taxes. This limit's been particularly hard on property owners. Well, the 10,000 was because some people are paying way more than that. New Jersey, New York, and California. What's common with all those states? Why are they paying so much? The different income tax regulations apply to mortgage loans on investment properties. Licensees should always recommend that clients consult with qualified tax persons about their tax regulations. But I just wanted to point out here how hypocritical a lot of these politicians are. You know, how they point out that the president is in bed with the rich people, but then when he tries to tax rich people, he's accused of hurting their states because they tax people more in their states, you know. So he just proved the point. He lowered the taxes on most people, gave them bigger deductions, and excluded people who make a lot more money and should be paying a lot less in taxes from being able to benefit from these deductions. And then governors of blue states started complaining. The other politicians in Congress and Senate from those states started complaining. So he said, all right, screw it. I'll put it back up to 40,000. But my point was proved. You want me to, you say I'm in bed with the rich, but then I try to tax the rich. And then you complain that I'm taxing your people too much because you're overtaxing them. I guess you don't like the how glaringly obvious that makes it. So Anyway, that's the law now. So this was actually raised to 40,000. So you may want to change that in your book where it says 10,000 to 40,000 because that's the current SALT debt limit that he just raised it to in 2025. And let me see if the Tax Cut and Jobs Act, let's see what kind of property values that affects. Let's see if that was affected anything here in New Jersey as well. What is the TCJA? Uh, Property value um, loan limit to deduct interest in New Jersey as of 2026. Okay, that's still the same. So it's 750 down from 1 million. This got raised to 40,000. However, if you refinance, it's up to 1 million. All right, so there you go. Anyway, don't need to know any of that for exams, just to show you how politics does play a role in real estate and the costs, how much you could deduct on taxes, etc. So a point, what is a point? It's prepaid interest on the loan. And how do you calculate a point? Each point is 1% of the loan amount, not the purchase price. And the IRS allows the buyer, the borrower, to deduct them. If you haven't yet, highlight that here on page 274. So you're highlighting.
I'm sorry, on page 274, where it is mentioned it's 10,000 tax deduction, we have to do it 40, right?
Yeah, change it to 40.
2025
Here.
onwards.
There where it says SALT is now 40,000.
Thank you.
This information is correct up top, but this one is 40,000. And then you're highlighting a point is prepaid interest, and each point is 1% of the new loan. That's how you calculate the math of a point. And then I wanted you to highlight in the next paragraph, the IRS allows the buyer to deduct them because it's their loan. So points are tax deductible by the buyer in the year they're paid. So if they prepay interest, look, they say here on an $80,000 loan, each point would be $800. So if you had to pay 2 points, that's $1,600. You only pay that one time to lower the interest rate or to qualify for the loan, depending on your situation there. Okay, a buy down, I just told you, is you could prepay interest in order to get a lower interest rate on your loan. Never makes sense to do that. Your money is worth more in your pocket. So you're better off putting it as a down payment or towards the principal instead of trying to buy a lower interest rate. The money is more valuable in your pocket today than it is down the road, especially if you don't own the property long enough to for the saving to pay for the lower interest rate, right? So if you're one of those people that aren't going to stay in the property for years to come, you could purchase a lower interest rate. You're never going to realize the savings. Okay, they call it risk-based lending for a reason. If the lender loans you money, it's all based on the amount of risk that you pose to the lender. The lower the risk, the more favorable the interest rate they're going to give you because it's less risk to them. The more risk comes the higher reward for the lender for risking their money by lending it to you. So that's what I mean by risk-based lending. So the best interest rate you could get is tied to the amount of risk to the lender. And factors include the down payment amount, how much down payment you're making, your credit score, your debt to income ratio, and the value and condition of the property, and the local market conditions. Are they stable? Are they declining? Are they increasing? Now, PITI is your total monthly mortgage payment when you include your property taxes and homeowners insurance in it. So it includes the principal and interest, that's your loan, plus the monthly property tax and homeowners insurance. That's what PITI stands for. Principal, interest, taxes, and insurance. That itself will be a question on exams guaranteed. Okay, now, if you're buying in a condo, you also need to take into consideration the monthly HOA fee that you pay as well, because that could affect how much you could borrow, because it is a regular anticipated expense that you're going to have. In addition to the property taxes and insurance and the loan, that monthly housing expense. So PITI is known as a budget loan. PITI loan is known as a budget loan because it includes those other housing expenses all wrapped into one payment. So you could budget your expenses better. So that's why they call it a budget loan. So PITI loan is also known as what? A budget loan. Now that could be an exam question, hint, hint. Now, lenders will incentivize borrowers to include their property taxes and homeowners insurance payments in your monthly mortgage payment. And often they do that by bribing you, by giving you an 1/8 of a point discount on your interest rate. Whatever interest rate you qualified for, if you include your taxes and insurance in your mortgage payment, which you don't have to, by the way, if you do, they'll give you an additional 1/8 of a point discount on your interest rate on average. Also, if you pay an extra point, if you want to purchase a lower interest rate, on average, getting an 1/8 of a point lower on your interest rate will cost you about a point. The math don't jive, right? You're prepaying 1 point of interest in advance. In exchange, they'll give you an 1/8 of a point discount. You better be in it long enough for the juice to be worth the squeeze. Or don't do that. Just pay down the principal with that extra money. Okay, now reserves and RESPA. Reserves is an amount of money built up for the coming year's future expenses. And the first time you're charged in advance is to help build up that reserve account is for your closing costs at the time you purchase the property. Your closing cost is largely made up of your coming year's property taxes and homeowners insurance payments to build up that reserve account for the coming year's bills. So if you don't include your taxes and insurance in your mortgage payment, could it be cheaper to purchase a house? Yeah. You don't need all that additional money for building up a reserve because you're going to pay those bills on your own. You don't need to build it up for the lender, so your closing costs are less. RESPA is the Real Estate Settlement Procedures Act, RESPA. It limits the amount of reserves that a lender may charge. Lenders do periodic accounting annually and must return excess money in the reserve account that is over $50 above the allowable threshold of amounts of money that they're allowed to collect, whatever amount that is. So this is why sometimes throughout the year, you may get your mortgage bill and they'll tell you uh, your reserve account is a little low. You need to pay a little higher this month to make up for that. And then they do accounting several months down the road. Oh, we got too much money in your reserve account, so your monthly payment this month is a little bit less. Okay, this is how they do their accounting here. Okay, they got to do that periodic accounting. So generally, your mortgage loan payment's the same all the time. So what would affect your monthly reserve account? Those factors that do change: property taxes and homeowners insurance.
I didn't get RESPA. I mean,
It's a law. It's called the Real Estate Settlement Procedures Act.
it's a law.
There's a lot of things that are covered by RESPA law.
Okay.
Everything from the closing document that's used to do all the math for the closing, to RESPA laws like this one, which limit the amount of money that the lender is allowed to charge you as the home buyer for the coming year's expenses. You know, because what you do is in your closing costs when you purchase a property, if you include your homeowner's insurance and property taxes in your monthly mortgage payment, the lender needs to get that additional money built up in the reserve accounts for those coming year's expenses, because you're going to pay them quarterly. So they need to start building up a reserve for that to make the quarterly payments. And they start out when you first purchase the property, you need to pay some extra money at the closing to start the reserve account. You good now? You clear? Okay.
Is that the escrow account?
Yes, that's the escrow. They call it reserves because it's built up for the coming year's payments. But that money's held in the
Escrow for lenders.
in the escrow account. Yeah,
Escrow
this is an
for
escrow.
lenders.
Correct. So look, real estate brokers have escrow accounts. Attorneys have escrow accounts where we hold other people's money temporarily, and lenders have escrow accounts for holding your reserves for the coming year's future expenses. Yes. Okay, so let's just highlight this now. PITI, principal, interest, taxes, and insurance reserves. And a PITI loan is sometimes called a budget loan. And RESPA, the Federal Real Estate Settlement Procedures Act, limits the amount of tax and insurance reserves that a lender may require. They can't require you to pay like 2 years in advance. You know, there's a limit on how much they could charge, and it's usually for the 1 quarter coming expenses. Okay. Check out this guy. He's like a wannabe Count Dracula, you know. All right, I'm knocking him for his style and his look there. I don't know. Maybe you might like Dracula here. He even took to it to file his teeth down to look like he's got fangs. But the guy's actually pretty bright. You know, can't say that crazy people aren't smart sometimes, but this guy's actually pretty bright. He's familiar with RESPA law. This is an old video that I got, but it's pretty interesting. I showed you guys a video the other day about how somebody was able to foreclose on Bank of America. Okay, here I'm going to show you. This is another example. He decided to foreclose on Wells Fargo. Why? Because they force placed a homeowner's insurance on his $190,000 house in Pennsylvania. They required him to get a policy for $1 million. And $1 million policy is going to be a lot more expensive than one for a $190,000 house. So this is what he did. I'm going to let him explain it himself here. This is what he did to undo that and to force the bank to justify it. And there's certain regulations that lenders need to follow according to RESPA rules and TILA, Truth in Lending Act rules. Lenders are required to respond to consumers' inquiries. Let me finish by letting him explain it. Let me just minimize everything here and you guys can see.
This morning from Philadelphia. Hey, Patrick.
Hey, how are you?
I'm doing well. So explain this for us. You actually had a home that Wells Fargo came to you and said, look, you need to take out a homeowner's insurance policy that you don't think it's worth the value of your home. What did you do to Wells Fargo in response?
I told them I wasn't going to renew that policy that they were having me renew. I had an insurance policy on my house, which I had bought for $180,000. And Wells went to the insurance company and said that they wanted me to insure it for $1 million. And as you can imagine, the premium on a policy like that is through the roof. So I said, no, I'm not going to do it. And they said, well, we're going to do it for you. And they force-placed an insurance policy for me that doesn't cover me. It only covers them. And that was the genesis of a dispute with them that's been running for nearly 2 years now.
Well, we did reach out to Wells Fargo, got no response from them. It sounds just like your experience with them, no response at all. Are you surprised by that?
Welcome to the world of dealing with Wells Fargo. No, I'm not surprised at all.
You also then found an interesting loophole, or not a loophole, but you found an interesting law dating back to the 1970s, which enabled you to work this angle, which is they needed to respond to you within 20 days. They needed to respond to you with written responses to your inquiries. They didn't do so, and therefore you were able to place a levy on their office and foreclose on them?
That's true. There's a law called RESPA, and there's a 20-day window that they have to acknowledge receipt of your request, and then they have 60 days to actually respond to that request. And if they don't, it's possible for you to collect damages and even additional fines on top of the damages. So I took them to court here in Philadelphia through the municipal court system. I won a judgment. They ignored the judgment. The court advised them they had to pay. They ignored that court's advice. And so I got a sheriff's levy, and when they ignored that, I ordered a sheriff's sale on their branch in downtown Philadelphia. And they still weren't going to pay. But let me tell you, when the media coverage started and it was on the front page of the business section that their office furniture was going to be sold off to pay a judgment, I had a check in my hands the next day.
Brilliant. And I can imagine a lot of viewers this morning waking up wondering if they're in a similar position. Do you think that your story opens the floodgates for other people watching this morning?
I think it does. I mean, people ask me what I hope to get out of this, and one thing is if I wind up being the Johnny Appleseed of RESPA letters, I would absolutely love for that to be my epitaph. These RESPA letters are not difficult to write. There are numerous consumer resources sites on the internet. There's government sites on the internet that will help you with that process. And these RESPA letters, the banks are legally required to respond to them. So I would say to consumers, these are a very important tool if you're having a problem communicating with your mortgage lender.
Patrick Rogers from my home city of Philadelphia, good luck to you, and thanks for coming in and telling your story this morning.
Thanks for having me on.
Thanks, Patrick. Coming up.
All right, so as you can see, there are RESPA rules in place, these RESPA letters that require lenders to respond to consumers' inquiries about things. And if they don't, they could be fined. And then if they ignore those fines, they could be multiplied. And so he then took them to court to pay the fines because those fines can be significant amounts of money. They refused to pay it. He's like, all right, I'm going to foreclose on you. He got a judgment against them and went down to one of their banks, and they still weren't going to pay it. But, you know, in the media, when it looks like that they're going to be foreclosed on, their furniture sold at auction, you know, to pay the bill, that doesn't look good for the bank's reputation. So they decided they broke down to pay. They leverage. This is leverage.
Here on the show this morning.
All right. So let's do some math. A point is prepaid interest on the loan. It's tax deductible by the borrower in the year it's paid, no matter who paid them. So remember the math of a point. Each point is 1% of the loan amount, not the purchase price, but the loan amount. So if you get a question like this on exam, which you probably will sooner than later, hint, hint. Now, it's not the same exact question. The numbers are different, but it basically works the same way. If the purchase price is $325,000 and the buyer has to put down 20% and pay 2 points and 5,000 in closing cost, how much money does the buyer need to purchase? You're going to get a question like this on the school exam. So there's a little trick to this, though. You have to know how a point is calculated and when you calculate.
On the loan.
So break it down. When you guys get the number, let me know. Don't tell me what the number
Okay.
is.
Okay.
Try to find the answer. Try to figure it out. Let me know when you got it, but don't tell me what it is. I want everybody to get an answer. And then I'm going to reveal the steps on how to figure it out right here on screen. Okay. I just want you guys to give a crack at it first. Okay. Got your scrap paper. You could use a calculator. That's fine.
I got it.
Okay. Anybody else still working on it, or should I start revealing, or are you guys close? Need a little more time?
I think I got it.
Kiddo. So let's do a reveal here. The first step is you take the purchase price and figure out how much the down payment is. 325,000 times 20%, that's $65,000. That is your down payment. So you need to have that $65,000. You also need to pay 2 points and pay 5,000 in closing costs. Well, how do you calculate a point? It's based on
Loan.
the loan
The
amount.
loan.
Okay, so is 325 the loan amount? No.
No.
You have to subtract your down payment from the purchase price, and then whatever's left over is the loan amount. So 325 minus that 20%, that $65,000 down payment gives you the loan amount of 260. Now take 260 times 2%, and that's $5,200. That's your 2 points. Now you take the 65,000 plus the 5,200, the 2 points, plus that 5,000 in closing costs, for a grand total of $75,200. That's how much money you would need to purchase this property, requiring a 20% down payment. Typically, conventional loans require 20% down payment. Not always, they could offer less, but typically. Okay, so anybody want to snap a picture of this? Go ahead. All right. So now let's take that same exact
Can you
problem.
go back, please? I had internet trouble. I need to take
There
the
you go.
picture. Okay, hold on 1 second. Okay, thank you.
You're welcome. Okay, here's that same exact question worded a different way. So the question was, if you purchased, if the purchase price is $325,000 and the buyer has to put down 20% and pay 2 points and $5,000 in closing costs, how much money does the buyer need to purchase? Another way that it could have worded it, that this could have been worded, but it requires more knowledge from you to figure it out, but it's the same exact question. If the purchase price is $325,000 with a LTV of 80%, and the buyer needs to pay 2 points and $5,000 in closing costs, how much does the buyer need to complete this purchase? Same exact question. You just need to know what an LTV is. It's a loan to value ratio. That means that the lender will loan you 80% of the value. So if they're lending you 80%, how much do you need to put down? 20. So you needed to figure that part out. The question didn't tell you that exactly. You needed to figure that part out. So that's what made this question worded differently, slightly more complicated. It ain't that much more complicated if you know what an LTV is, though. So that's another way it could have been worded. Okay. So let's take that same property that required what, $75,200 or something like that to purchase. If we use an FHA loan to buy that same property, how much money does the buyer need to complete that purchase? If it's $325,000 purchase price with a 3.5% down payment, 2 points and $5,000 in closing costs. Well, take 325 times the down payment of 3.5%. That's only 11,375 instead of the 65,000 the 20% traditional loans would require. Then you calculate your points. Now your points are going to be a little bit more money here because the loan is a higher amount because it required less of a down payment. So 325 minus that 3.5% down payment gives you a loan amount of 313. Times the 2 points, that's 62.72 and 50 cents in your points. So you take the down payment amount, the points, and the closing costs for a grand total of $22,647 and 50 cents. Using an FHA loan, these types of higher LTV programs make it a lot more affordable to get into housing, don't they? The other one required under your traditional conventional loan with a 20% down payment and all the same terms, you needed $75,200, something like that. This is a lot less, making it a lot more affordable to get into housing. These are how these government insured programs to get loans to buy real estate can be a lot more affordable to get into housing. And once again, your monthly payments first get applied towards the principal, the interest, and then the balance towards the principal over the first half of the term. But the majority of that goes towards the rent, the interests. And then about halfway through, it starts to flip a little bit. And here's that mortgage factor chart again of how we use to figure out what your monthly mortgage payment is for principal and interest. So here's just a little bit of relief for you from another business news program. By the way, notice I grab my news from several different resources, and it's always the business networks I get them from. I don't get them from the traditional, like this is Fox Business Network. I don't get it from Fox News. I get it from the Fox Business. If it's from CNN or MSNBC, it's going to be from their business channel, not their regular ones, because all the other stuff tends to be partisan rhetoric, and a lot of it's BS. But their business channels, you'll get the most truth out of, okay? Because they've got to be honest to investors out there, because if they're not if they're playing with the numbers, playing political games, they're not going to use that as a reference for reliable, truthful information. So the business channels tend to be a lot more truthful when they're explaining the news. If you'll notice that. There's still maybe some biases, but for the most part, it is more accurate. But check this out. What states are the most and least affordable to retire in? You guys have a savings?
The report, by the way, noted that even with $1 million in retirement savings, the average person would only be able to cover about 14 years of expenses in New York City, and I'm not sure it would go that far. New Jersey came in 49th in affordability, followed by Vermont, Massachusetts, Maryland, Washington, Connecticut, Maine, Illinois, and Oregon. California not in there, making up the bottom 10. Okay, let's get to the other.
I wonder if they ran those numbers now, if California would be in it, because this was a couple of years ago. This is maybe about 2-3 years ago. All right. Now let's see what are the most affordable states to retire in with $1 million. So in New York City, if you retire with $1 million, you may last 14 years.
The side of the story. Where's the most affordable place? Alabama, number one, as the most affordable state to retire in, followed by Tennessee, West Virginia, South Carolina, Wyoming, Delaware, Georgia, Arkansas, Florida, and Mississippi. In other words, the South. All right, Stu, there you go. New York, though, not very affordable, apparently.
that was a very nice summary. In other words, the South.
All right. So let's look at this question here. I show you in this box how to calculate your monthly payment. Here's the formula. Here's the formula on how to calculate your monthly interest rate and how to calculate your monthly principal, how much of your monthly payment goes towards the principal. So I'm giving you all the formulas here, okay? Now here's the question. If you have a $400,000 loan for 30 years at a 5% interest rate, using that factor chart in your book, what is the mortgage factor that you guys come up to? You remember how to read the chart. Run your finger down the interest rate and then across to the 30-year column. And what is the factor you get for 5% interest at 30 years?
5.37.
5.37 is correct. So the factor is 5.37. So for every $1,000 borrowed, your mortgage payment is $5.37. Okay, but that includes both the principal and interest. Let's figure out what is your monthly mortgage payment and how much of it goes towards the principal. So if you have a loan, remember it's per $1,000 borrowed. If you're borrowing $400,000, you could just cross out the last 3 digits and it gives you 400, or you could divide it by 1,000. Okay, either way, it gets you the same number, 400. Times it by the factor of 5.37. Your PI, the principal and interest, that's your loan amount, is $2,148. Now, how much of that goes towards your principal? What's the first step that we should do? Walk me through this. So I don't care if you know the math. It's a matter of using a calculator. Walk me through this. What's the next step that you would do?
You will minus interest from PI to get the principal amount.
Okay, so how do we figure out the interest though?
Interest.
It's in front of you. You could read through it and just tell me. I just want you guys to be able to figure it out.
Okay. Loan amount into interest is equal to annual interest.
Okay, so then what do? We take the full loan amount and do what with it?
You will multiply it with the interest rate.
Okay. So we take the loan amount of 400,000 times it by the interest rate of 5%, which the question itself gave us
That's
this
annual.
information, right?
Yeah.
And that gives us $20,000 in annual interest
Divided by 12 months.
divided by 12 months, because there's typically 12 monthly mortgage payments in a year, right? That gives you the interest of
Interest.
1666.
And then you will minus PI minus
So
I
we take the PI minus the I,
to get
shake
the
it all
principal
about,
amount.
and you get the P, the principal of
Right.
$482. So your mortgage payment of $2,148, only $482 went to pay back the loan.
Yeah.
Damn, how do I become a lender? Well, yeah, I guess you got to have a lot of money to begin with, right? But look at that. If you have a lot of money to lend, you could make a lot of money lending money. Huh? Look at that. All right. Let's give another question. Taking that same problem, if we have property taxes of $9,000 and property insurance annually of $900 a year, what would be the pity payment? Here's just a refresher. The PI is $2,148. So what do we do to figure out pity? Your mortgage payment consists of PI, but we're trying to figure out if it included taxes and insurance, what it would be. So what do we do?
So we should add the property insurance and the tax
Okay.
first.
So the annual taxes and the annual insurance, you add them and you
Yes.
get $9,900 in annual tax insurance payment. And then we have to divide that by 12 to figure out what the monthly is, right?
Yes.
That's $825 in TI. So you take your PI, you add your TI, you shake it all about, and you get your PITI,
Yeah.
right?
Right.
So that's how we figure out what our monthly total mortgage payment is. Look at that figure now. $2,973 is your pity payment. That could bring up your tax. Those taxes and insurance can really have an effect on how much real estate you could afford to buy, right? Now, how much of a loan amount that equals is another. They have another way of figuring that out. But first, this is what lenders do. They figure out how much you could afford to pay monthly, and then they reverse engineer it to figure out, well, now how much of a mortgage payment would that be? Right? Or how much of a loan amount that would be. So that's your pity payment. And if it was a condo, it also had an HOA fee. You would have to add that on top of that as well. All right. So how do we compare two mortgage loans? I showed you a little chart that showed you how to figure that out a little while ago. It's gonna come up again on the next slide. But let me just ask you, if you have a question like this, which you will get a question like this on state exam, without a doubt. They always ask a question similar to this that says, how much would you save on the interest payments over the life of a loan when you compare a 25-year loan versus a 30-year loan? If the loan amount is $300,000 and an interest rate of 5%, how much would you save on a 25-year loan versus a 30-year loan? So what would you guys do to figure this out? I'll reveal it on the next slide, but how would you figure this out? What would you do?
We will find out the interest interest rate.
Well, it's 5%.
And then we will 5% of 30,000.
Okay.
No.
You're okay. Hold on a second.
Mortgage with the mortgage chart, we have to figure out the
What the factor is
the factor is. Yeah.
for each loan.
Yes.
So basically what you're going to do is you're going to run the numbers side by side. You're going to figure out the numbers side by side for each loan.
Mhm.
So what is the mortgage factor on a 25-year loan at 5% interest? And what is the mortgage factor on a 30-year loan at 5% interest?
It's 5.85 for 25 and 5.37 for 30 years.
Okay. And so now that we have that, we could figure out what the monthly mortgage payment would be.
Yes.
And then what do we do?
We will see the difference.
Not with the mortgage payment, not with the monthly. This is asking how much would you save over the life of a loan.
And then don't we multiply it for the year of the loans? So we know the difference between the 25 and the 30, how much money you have been paid.
So what are you saying to do? To multiply
Mul-
the monthly mortgage payment by what?
By
Annually.
the number of the years.
Oh, you're
Well,
so close.
yeah,
You're so close. You're so close. You're almost there.
by the number
Okay.
of the
But
months of the
25
year
year,
times a year.
By the number of months in the term. So in a 25-year loan, 25 times 12 is 300 months. 20 in a 30-year loan, 30 times
36.
12 is 360 months. Okay, so here, let me just go to the next page and you guys can see. Okay, well, here's the chart again for figuring out the factors. Okay. And that was, what was it? For 25 versus 30-year loan at 5%, 25 is at 5.85, 30 years at 5.37.
Yeah.
And this is how you figure it out. You just go side by side. You put 25-year loan and a 30-year loan. Here's the factor for a 25. Here's the factor for a 30. Figure out how many months there are in the life of a 25-year loan. There's 300. You take 25 years times 12 months, or 30 years times 12 months to figure out how many months over the life of the loan. Now we figure out what our monthly mortgage payment would be by taking if it's $300,000 loan, how many thousands in 300,000? 300. So you multiply that by the factor because it's per thousand borrowed to get the monthly mortgage payment for each. 1755 for the 25-year loan, 1611 for the 30-year. Then you multiply that monthly payment, which includes both principal and interest, times the total number of months in 25 years. And you do the same for the 30-year loan. And that'll tell you what the total you would pay back for that $300,000 loan at 5% interest. For a 25-year loan, you would pay back $526,500. And for a 30-year loan, you'd have paid back $579,960 to borrow $300,000. Now, at this point, you could easily subtract one from the other and come up with the answer, but you wouldn't know how much it was you're paying in interest. So I don't want you to skip the next step. To figure out the interest over the life of the loan, all you do is subtract the amount you borrowed from the PI and you'll figure out the interest. Subtract the P from the PI to get the I for each loan. And now subtract one from the other and you can see the difference. $53,460 in savings of a 25-year loan versus a 30-year loan. So you save $53,460 of interest payments by paying it off 5 years sooner. That's a lot of do-re-mi, right? That's a lot of money right there. And you could save even more if you make one extra payment every year, apply it towards the principal. That could shave off an additional 7 to 8 years of interest payments off your loan. Or you could set it up as a biweekly mortgage if you're not good at saving the money. Set it up as a biweekly mortgage. It makes a half payment every 2 weeks, which ends up being taking a little bit, like it's like taking the change out of your pocket every day and just throwing it in a bucket and then using that money to make a mortgage payment at the end of the year if you don't touch the change in the bucket. Okay. That's what a biweekly mortgage basically ends up doing for you. Okay, here's a couple of other math problems for you, just samples I have here worked out already. You could go through the slides and see them, but we skipped that. Remember I taught you this on day one? The T formula. Okay, the way that it works is a small number always goes up top, the large number on one side and on the bottom, and the interest rate on the other. You divide down, multiply across to figure out the missing component. You need two of the components to figure out the other third factor, the third component. And TGIF, the top number always goes in the calculator first. When you're dividing down, you always put the top number in the calculator first, so you don't get confused. So you could use this T formula to figure out a lot of different types of math problems. When you're figuring out commissions, interest rates, cap rates, percentages of profit loss or tax rates, commission amounts, etc. So here's a problem you may get on state exam. If your monthly interest payment at 5% is $1,250 a month, what is the principal amount of the loan? How much did you borrow? Ooh. How do we calculate interest? What did I keep saying? How do we calculate interest? One word.
P is equal to
One word. How do we calculate interest? With one word. Answer it. Annually.
okay.
Interest is calculated annually, right? All right. So here in this question, that's a major clue. If the monthly interest payment at 5% is $1,250 a month, what is the principal amount of the loan? Well, I need to figure out what the annual interest is. So all we could do is we could take this monthly payment of $1,250 and times it by 12 months to get the annual interest. And then we could divide it by the interest rate to figure out the loan amount.
Mhm.
Of 300,000. You divide down 15,000 divided by 5% or 0.05 gives you $300,000. They were trying to be a little tricky with this question here by giving you the monthly payment instead of the annual payment for the interest. Remember, in order to calculate the full amounts, we're not looking for the monthly loan amount payment. We're looking for the total loan amount. So for that, we need to have not the monthly interest payment, but the annual. I guess you got to think along those lines to figure out what the numbers are that we need to plug into this T formula to figure that out. Okay. Once again, here's all the different types of problems that we could figure out with the T formula. TGIF, top number goes in the calculator first.
Oh, you skipped it too fast. Go back.
Oh, sorry. Oh, hold on. Now it doesn't want to go back. Hold on. There we go.
Okay, thanks.
You're welcome. This is a very helpful and useful chart of information here too, by the way. All right, so the Your Home Loan Toolkit, we're going to get into this right after lunch. Yeah, it's that time already. So, whoops, sorry about that. I forgot to hit record after lunch here. But so let me do a quick rundown again. The toolkit, the CFPB toolkit. This is a toolkit. This is a tool created by the CFPB to allow consumers to shop for home loans and compare loan costs. It must be given to the consumer within 3 days of their completed loan application, or aliens. Aliens is the acronym to know when all this information is supplied to the lender by the consumer trying to get the loan. Then the loan application is considered complete, and the lender is required to go over certain disclosures. And aliens is the acronym for when they provided the address of the property being purchased, the loan amount requested, the income of all the borrowers, their estimated value of the property, like through an appraisal, the names of all the borrowers, and their social security numbers. When all that information has been supplied, aliens are present, and now the lender is required to put in the mail within 3 days, 3 business days, the Your Home Loan Toolkit to send to the consumer. Nobody's required to go over it with them, but somebody should. You as the real estate agent should give it an look-see and go over those things with them. And I have these guides here from the CFPB, these links that I just shared with you. Wasn't in the recording. I'm redoing this now, so you have it in a recording if you watch this again. Now, the DOBI, the Department of Banking and Insurance, they also created this home buyer's guide, which we were just looking at. I'm going to go back to it. Okay. And it talks about, your credit scores and such. Credit scores go up to 850. The Fair Isaacs and Company, that's where they get the FICO name from. They invented this credit scoring system. But this goes over a lot. If you were just to read through this guide, it goes over a lot of these things that we've gone over, like the different types of loans, what rate locks are, etc. How to get your credit report every year. I just gave you an example. I was just showing the class how I keep track of my credit score and my expenses and such. I get alerts from Credit Karma app. You could download for your cell phone and have it available. It keeps track of your credit score with the 2 of the 3 major credit reporting agencies, for TransUnion and Equifax, not from Experian. But Experian, I think you could get if you have a Discover card. I think you get it from them, or a Chase card. I think they give you that as well. All right, and anyway, this is a good home shopping guide. It's good educational guide for you as new real estate agents to learn about the full home buying process. Even if you bought a home already, this will go over the details of it and explaining things that maybe your real estate agent and your mortgage reps and your attorneys were handling, what actually was going on there in the background. Now, this guide that the Real Estate Commission created has not been updated in a while. Most of it is still accurate, but it's a bit older. But it is a good guide. I asked them to update it, but still waiting for that to happen. So once again, if they don't do it soon and I get a chance, I'm going to update it a little bit and then post a copy of that on our Facebook page and our websites. And I do those free giveaways at our Facebook webpage. So make sure you go to facebook.com/Career Path Academy with no spaces. And like us, love us, and I'll give you free stuff at random every now and then. Okay, so they talk about the Real Estate Commission itself here, who they are, how many people are on it, what they do. They talk about commission rates and different types of agency, exclusive buyer's agency. They basically go over the whole home buying process. I'm not going to go over all of that just this moment right now, but that's another guide. And then you also have the New Jersey Housing Mortgage Finance Agency. They have a home buyer's guide too. Whoop, they moved it again. I just updated this recently and they moved it again. Great. Let me see if I could find that by doing a search. I know I had the link here. the HMFA. How about this? Here it is. So you guys can see what I'm doing. Okay, it's just back out the here a little bit. See HMFA. Okay, look at that. So Governor Murphy made some changes before he left office. That public notices that were required to be put into newspapers for people. Well, now they don't go in newspapers. He just posted, they just post them on their own website somewhere. So now you're going to have to try to track them down and search and hunt for them instead of just looking in your local newspaper for foreclosure notices and all kinds of other stuff. State tax credit auction. Tax credit auction. What kind of scheme are they working up now? How you could support the production of affordable housing by going to a tax credit auction. These politicians love tapping themselves on the back. Huh. All right, so they have NJHMFA has all kinds of loan programs available for the consumers, which we'll go over later in this chapter, or is it the next? It'll be one of them. But what were we looking for? We were looking for the NJHMFA's Home Buyer's Guide, right? And I got it somewhere. Let's just do a search here. Home Buyer's Guide. There we go. Nope, that's the one. That's the one I was just showing you. That's older on the Real Estate Commission's website. What did they get rid of this one? Come on. I'm looking for the one from the NJHMFA. See, they have different lending programs for first-time home buyers, for down payment assistance, for police and firemen and teachers. They got all kinds of programs available. And they've got classes and fact sheets. All right. We don't need that right now. I'm looking for that guide. Is that the guide? This maybe get a guide. That's the guide. Look at that. It works now. Okay, so let me change that change that link here on our slideshow. Okay, they just made it a little longer link. But here, because I sent you a bunch of links just a few minutes ago, that last one is no good. That one is. And I'll also need to fix that in our class links Word document. So let me take care of that real quick. And I'll upload that later. New class links and notes. So NJHMFA, let me search that. There you go, Home Buyer's Guide. Update that link. All right, now it's been updated. Good, good, good. And I'll upload it later. So it's available for you in the shared Google Drive, these documents, in that email that I sent you. So let's go back to that guide. So this is their guide here. It's a PDF document on how to shop for a home, how to compare loans, and all that stuff as well. This one was created by a New Jersey agency called the HMFA, the New Jersey Housing Mortgage and Finance Agency. And they make all kinds of programs available. Look, they got calculators here too for affordability calculators, biweekly mortgages, mortgage calculators, rate comparison calculator, realty transfer fee calculator. Wonder if that was updated with the recent change in the law. They talk about what we just went over, PITI, and the DTI, the debt to income ratios. They explain how those work. Okay. Just like that other guide from the Real Estate Commission. Okay, so let's get back to the slideshow now. So the Your Home Loan Toolkit, these are the topics that are explained. Yeah. How to determine affordability, how credit scores affect the availability of mortgage money, how to choose the best loan and down payment, understanding the trade-off between points and interest rates, the value for shopping of several lenders, how to avoid pitfalls and problems. They explain about the loan estimate and the closing disclosure, the CD. Now, what does the lender need to give the consumer within 3 days of aliens? The toolkit. That's the guide on how to shop for and compare loans. But they also need to give the loan estimate, the LE, formerly called the good faith estimate. That needs to be given within 3 days of the completed loan application as well. So let's highlight in the book, page 275, Your Home Loan Toolkit. Lenders are obligated to provide the booklet to borrowers within 3 business days of their completed loan application. None of these links will work anymore because they changed it. They moved it around. Unless these links are still good files, and then because that's not the same link that I have on their website to get to it. Maybe it just redirects. I don't know. Okay. All right, conventional, insured, and guaranteed loans. We're going to go over these now. Conventional loans are originated by what we call portfolio lenders. Portfolio lenders are those that lend their own money. They have no intention of reselling their loans in what is deemed the secondary market. So they write conventional loans, or sometimes they'll call them portfolio lenders. Sometimes they call them conventional lenders and refer to the loans as portfolio loans or conventional loans. Either way, they're talking about the same thing. They're lenders that lend their own money without the intent of reselling them in what's deemed the secondary market, which are basically other investors and banks and lenders. Sometimes they originate loans and they resell them right away. And portfolio lenders, they don't. They keep these loans in their own investment portfolios. As you could see, writing loans and then holding on to them and collecting the interest, you could make a lot of money. We showed you that example with 5% interest rates, right? On a $300,000 loan, you're almost doubling your money over a 30-year loan. Okay. So these loans are directly between the lender and the borrower with no third-party involvement or influence from outside sources who may set guidelines typically for the types of loans they're willing to buy. And so if you go to a bank normally to get a loan, and they say, well, you don't qualify for this loan. Well, what makes you qualify or not qualify? Well, some sort of lending guideline. Now, lending guidelines are determined by what? Well, we do have the risks to the lenders, but beyond that, most banks and lenders write loans with the intention of not servicing them for the next 30 years, but to sell those loans to an investment group that will hold on to them for the term. And what they'll do is they'll get all of their money back, plus some of the interest, plus they may be paid a servicing fee to continue doing the billing and collections and accounting for these loans for the investor that just bought it. And that's how your local banks make money. They originate loans, then they sell them to investors, get all the money back so they can lend it again. But they also get paid sometimes a servicing fee to continue doing the accounting for these investors and the collections for the loans. Now, conventional loans typically require higher down payments, 20% or more. But sometimes I've seen them as low as 3% down payment. So I guess it really depends on various factors of the lender. Government-backed loans usually allow for higher LTV ratios, loan-to-value ratios. So they'll lend you more money, requiring less of a down payment. With government-backed loans like the FHA that insures loans but does not lend money. The VA, that's the Department of Veterans Affairs. They give loans, they guarantee loans, 25% of the loans made to veterans. So basically, just like with the FHA, you don't get loans directly from the FHA, you get them from your local lender. The FHA then insures that lender against loss if you default on the loan. The VA, they guarantee 25% of the loan. So it's as if the veteran put down 25% at the time that they're getting that loan from the local lender. So they don't need to carry private mortgage insurance either, which we didn't get to just yet. Neither the FHA or the VA lends money. They only insure it or guarantee it. Who insures the loan?
Lenders.
The FHA.
Okay.
FHA insures loans. The VA guarantees them. So both the FHA and VA require purchase contracts contain a special amendatory clause added to their purchase contracts that stipulates if the house does not appraise for the purchase price, the buyer can get out of the contract without penalty. You need to know that for exams. What is the purpose of the special amendatory clause that is required to be in all contracts where the consumer is using an FHA or VA loan? What is the purpose of it? The purpose is
Buyer can get out of the
Yeah.
contract.
without penalty if the house does not appraise for the purchase price. Okay. So the NJHMFA, that's the New Jersey Housing Mortgage and Finance Agency. They do not lend money directly either. They do what the federal government does too. They have some programs where they insure loans and other ones where they guarantee them. The loan comes from approved lenders through their various loan programs that they offer that agree to follow their rules. And you could also get loans directly from the government. Those loans you get from the REC-D. That's the Rural Economic Community Development, formerly called the Farmers Home Loan Administration. These are loans that are funded directly by the USDA, the U.S. Department of Agriculture. You don't need to have a farm to get these loans. You just need to live in a rural area. Now, what is considered rural? Well, what is rural? Remember this. We have city is densely populated with high rises and apartments, a lot of people living within close proximity. Suburbia is a little bit less densely populated. And then you have rural. That's like farmland or living out in the country, the sparsely populated areas. And these loans are also available to those that live on Indian reservations as well. Once again, another graphic explaining the difference between urban, suburban, and rural areas. So let's do the highlights now for the conventional, the government-backed FHA and VA loans. Also put the note in here that the maximum seller concession allowed for an FHA and VA loan is 6% of the loan amount. You guys remember what a concession is? It's any money that the seller gives up to the buyer, conceding to the buyer to help them with their closing costs or maybe for repairs on the house. The maximum that that can be is 6% of the loan amount. And for your typical conventional loans, the maximum seller concession allowed is 3% of the loan amount. So do all these highlights, write all your notes here. Conventional loans originated by portfolio lenders with no third-party involvement or influence. Yeah, warm outside, huh? Also getting warm inside for that matter. 85 degrees today.
Finally.
I don't like it too hot either, you know? I like a mid 70s.
But it's nice out there. It's a nice breeze to the wind. It's not like aggravatingly hot, but it's beautiful.
Yeah. I like weather where I'm not going to sweat too much, but it's not so chilly. I got to wear
Pleasant,
a
pleasant
coat.
weather.
Yeah, yeah. It's good for me to ride my motorcycles or go out on my friend's boat, you know, things of that nature. Motorcycles, you wear the leather vests and stuff, and that stuff can be pretty hot too. All right. So let me know when you guys are done getting these information down here.
All set.
What do you say? What is the name of that bike?
Which
Uh,
one?
Harley Davidson.
no, no, not the brand. What do they call? I'm just forgetting the name. Um, it's like boat shaped bike.
A
So I was
board
good.
shape?
No, no, I'm just forgetting the name. In some time, I'll remember. I'll get it. So I was going to New York, and approx 90 to 100 bikers were there, and vroom, vroom, vroom.
Yeah.
The slingshot, slingshot.
Oh, those are not motorcycles at
These
all.
are not motorcycles. Okay.
They try calling them motorcycles, but they're not.
Okay.
They have three tires and they sit low like a family
Yes.
car
Yeah.
without a roof on it. Yeah.
Yeah.
Yeah,
So they were approx 100. So first I ignored. I thought no, it's just like. Then I started recording, and my recording went up for 3 minutes. Vroom, vroom, vroom. I don't know where they were going, and was there any kind of group or event, because I was
yeah.
going for a mermaid parade, and I don't know where they were heading to.
May have just been a little gang that stayed together there, or who knows? Maybe it's just a group
Very
of
big
bikers that go
gang.
out biking. But
Yeah.
New York City is not the place where you go to take out just to go for a bike ride. It's not exactly a scenic route to ride in. You know, they got all those traffic cameras, the speeding cameras. You got the bumper to bumper traffic, reckless drivers that are cutting in front of each other. They will think nothing of hitting a biker, you know. not the ideal place. You're better off going for these long rides in the country and stuff, getting out of the city,
Maybe.
the back
Yeah.
roads, the police escorted rides. Those are the types of things that I do. We set up a bunch of those things through the American Legion, and now I'm with the Moose Group, and we're trying to set up a riders club like that as well. It basically is a charity fundraisers. Anytime you usually see huge groups of bikers, like really big groups, uh, they're usually not driving recklessly. They're just there cruising, waving to the crowds, and they're there for fundraisers. All those bikers pay money to go on this ride. They pay money to be in a charity fundraiser ride, and it's usually police escorted. There's actually a huge one that's coming up. I forget if it's this weekend or next. There's a huge one coming up soon called Rolling Thunder. Oh, there you go. You got your recording of the Lakers. Yeah. I have some of those as well. We had one where they shut down a lane on the turnpike just for us. Actually, the whole center lane of the turnpike, which is several lanes, they shut down just for us. We had several thousand bikers there. We were this was about 2 years ago. We were on the news. We were escorting a fallen soldier from World War II whose remains were finally identified and brought back to the United States. So all the bikers met him at the airport where the body was then transferred. The casket was then transferred to the to the car that carries them back to the home city. In this case, it was Metuchen. So we drove up to Newark Airport to retrieve the body, and it's nice, the ceremony. If you get to witness the ceremony where the casket comes off the plane and how they take it, we got all those videos up there on. You could take a look at the Facebook page I put together for them. It was um, uh, ALR 65, American Legion Riders Post 65 in Rahway. I'm sorry, in Metuchen. But we got thousands of bikers from all kinds of different groups for that. And sometimes it's that it's not charitable fundraisers. It's just respect for veterans and bringing back their remains. And which is incredible. After what was it, 80 years or something like that. His remains were recovered and finally brought back home. So it was on News 12 and everything. A lot of our guys got interviewed. It's little stuff like that. We do charity rides for around Christmas for Toys for Tots and stuff to raise. It's a fun thing, and you don't get people driving nutty and reckless at those things, and it's usually police escorted. We get rides to Pennsylvania. Rolling Thunder is a huge one. It starts in Warnaco Park in Roselle. And then it goes all the way down to the Veterans Memorial Center, where the PNC Art Center is. That's the Veterans Memorial over there. And it goes all the way to there. So it's a nice little ride. They block off the roads for quite a while where you can't cross the road because there's so many bikers. You got to wait for them to pass by. But it's fun to watch all the different bikes and such. Or if you're riding in it, it's fun. All right, everybody got these notes down? All righty. So how lending works in a nutshell. This is my explanation to you. Most lenders, they don't lend their own money. And those that do, they're called portfolio lenders. And their loans are called conventional or portfolio loans. Now, who do consumers get loans from? Where do you get a loan when you need to buy a house? Well, you go to your bank, credit unions, or private investors. Now, some of those private investors that supply funds through mortgage reps could be from insurance companies, investment funds, hedge funds, all kinds of things like that could be investing in there. But insurance companies and investment funds are usually some of the bigger ones. Um, these are some of the common sources of getting funds for loans. Now, banks lend their depositors money. Now, technically, this is not correct, but it's an explanation you guys can grasp and understand right now. So let me just give it that explanation so you get a better understanding of how banking works. Banks lend their depositors money according to some third-party investors' criteria, which we call the lending guidelines, for loans that they're willing to purchase. Then they sell that loan later to get their depositors' money back, plus some of the interest paid up front as the profit. That's how banks get paid for originating the loans. They originate the loan between the consumer and the lender to buy a house. When they close on it, often a couple months later, you get notified your loan has been sold to a different lender, and now you're going to be making payments either to the same one or to a different lender. Okay. Now, sometimes those investors will also pay the bank a servicing fee to continue doing the collecting of the monthly mortgage payments and billing and rendering accounting to the consumer and the lender. That's how your local banks make money, by lending. Now, the primary mortgage market is what we call it, where you go to get a loan to buy real estate, where the consumer goes to a lender to get a loan to buy real estate. This is known as the primary market or the primary mortgage market, okay, where loans are originated to consumers to purchase real estate. And now when those loans have been originated and they get resold to investors, they call that the secondary market or the secondary mortgage market, it could be referred as. These are where those loans that were originated in the primary market are then resold to investors, which could be banks, they could be insurance companies or hedge funds or what have you. That's how banking works in a nutshell. But this video is that video where I got that cartoon from for the last chapter, explaining to you how usury, what usury is. You guys remember what usury is? Charging an illegally high rate of interest. Well, that guy that created that video, it's a whole long, it's like a 47-minute long production in a cartoon fashion. It's a little fictitious story he put together to explain how lending works throughout the world and in the United States. Okay. How money gets its value. It's called Money as Debt. All right. I've got a couple of versions of it here. This one I think is the best one. So I'll share the link with you, but we're going to actually watch it. Or we're not going to watch the whole thing. We're going to watch, though, about 15 minutes of it on the next slide. So let me share with you that link. So you guys, if you are interested in watching the full movie, you could watch it right there. It was created by this global economist from Canada, I think, where he simplifies and dumbs everything down so everybody can understand. So this is how lending works in a nutshell. So let me shut off the videos so the stream is better, and then let's watch it. It's very entertaining. I'm going to take this step further. We're going to open it up on YouTube and make it full screen here. There we go. Wow, look at that. Permit me to issue and control the money of a nation, and I care not who makes its laws. Anybody recognize the last name on this guy? Rothschild, the Rothschild family.
Two great mysteries dominate our lives: love and money. What is love is a question that has been endlessly explored in stories, songs, books, movies, and television. But the same cannot be said about the question, what is money? It's not surprising that monetary theory hasn't inspired any blockbuster movies, but it was not even mentioned at the schools most of us attended. For most of us, the question, where does money come from, brings to mind a picture of the mint printing bills and stamping coins. Money, most of us believe, is created by the government. It's true, but only to a point. Those metal and paper symbols of value we usually think of as money are indeed produced by an agency of the federal government called the Mint. But the vast majority of money is not created by the Mint. It is created in huge amounts every day by private corporations known as banks. Most of us believe that banks lend out money that has been entrusted to them by depositors. Easy to picture, but not the truth. In fact, banks create the money they loan, not from the bank's own earnings, not from the money deposited, but directly from the borrower's promise to repay. The borrower's signature on the loan papers is an obligation to pay the bank the amount of the loan plus interest, or lose the house, the car, whatever asset was pledged as collateral. That's a big commitment from the borrower. What does the same signature require of the bank? The bank gets to conjure into existence the amount of the loan and just write it into the borrower's account. Sound far-fetched? Surely that can't be true. But it is. To demonstrate how this miracle of modern banking came about, consider this simple story, the goldsmith's tale. Once upon various times, pretty much anything was used as money. It just had to be portable, and enough people had to have faith that it could later be exchanged for things of real value, like food, clothing, and shelter. Shells, cocoa beans, pretty stones, even feathers have been used as money. Gold and silver were attractive, soft, and easy to work with, so some cultures became expert with these metals. Goldsmiths made trade much easier by casting coins, standardized units of these metals whose weight and purity was certified. Well, to protect his gold, the goldsmith needed a vault, and soon his fellow townsmen were knocking on his door, wanting to rent space to safeguard their own coins and valuables. Before long, the goldsmith was renting every shelf in the vault and earning a small income from his vault rental business. Years went by, and the goldsmith made an astute observation. Depositors rarely came in to remove their actual physical gold, and they never all came in at once. That was because the claim checks the goldsmith had written as receipts for the gold were being traded in the marketplace as if they were the gold itself. This paper money was far more convenient than heavy coins, and amounts could simply be written instead of laboriously counted one by one for each transaction. Meanwhile, the goldsmith had another business. He lent out his gold, charging interest. Well, as convenient claim check money came into acceptance, borrowers began asking for their loans in the form of these claim checks instead of the actual metal. As industry expanded, more and more people asked the goldsmith for loans. This gave the goldsmith an even better idea. He knew that very few of his depositors ever removed their actual gold, so the goldsmith figured he could easily get away with lending out claim checks against his depositors' gold, in addition to his own. As long as the loans were repaid, his depositors would be none the wiser and no worse off. and the goldsmith, now more banker than artisan, would make a far greater profit than he could by lending only his own gold. For years, the goldsmith secretly enjoyed a good income from the interest earned on everybody else's deposits. Now a prominent lender, he grew steadily richer than his fellow townsmen, and he flaunted it. Suspicions grew that he was spending his depositors' money. His depositors got together and threatened withdrawal of their gold if the goldsmith didn't come clean about his newfound wealth. Contrary to what one might expect, this did not turn out to be a disaster for the goldsmith. Despite the duplicity inherent in his scheme, his idea did work. The depositors had not lost anything. Their gold was all safe in the goldsmith's vault. Well, rather than taking back their gold, the depositors demanded that the goldsmith, now their banker, cut them in by paying them a share of the interest. And that was the beginning of banking. The banker paid a low interest rate on deposits of other people's money that he then loaned out at a higher interest. The difference covered the bank's cost of operation and its profit. The logic of this system was simple, and it seemed like a reasonable way to satisfy the demand for credit. However, this is not the way banking works today. Our goldsmith banker was not content with the income remaining after sharing the interest earnings with his depositors, and the demand for credit was growing fast as Europeans spread out across the world. But his loans were limited by the amount of gold his depositors had in his vault. That's when he got an even bolder idea. Since no one but himself knew what was actually in his vaults, he could lend out claim checks on gold that wasn't even there. As long as all the claim check holders didn't come to the vault at the same time and demand real gold, how would anyone find out? This new scheme worked very well, and the banker became enormously wealthy on the interest paid on gold that did not exist. The idea that the banker would just create money out of nothing was too outrageous to believe, so for a long time the thought did not occur to people. But the power to just invent money went to the banker's head, as you can well imagine. In time, the magnitude of the banker's loans and his ostentatious wealth did trigger suspicions once again. Some borrowers started to demand real gold instead of paper representations. Rumors spread. Suddenly, several wealthy depositors showed up to remove their gold. The game was up. A sea of claim check holders flooded the street outside the closed doors of the bank. Alas, the banker did not have enough gold and silver to redeem all the paper he had put into their hands. This is called a run on the bank, and it is what every banker dreads. This phenomenon of a run on the bank ruined individual banks and, not surprisingly, damaged public confidence in all bankers. It would have been straightforward to outlaw the practice of creating money from nothing. But the large volumes of credit the bankers were offering had become essential to the success of European commercial expansion, so instead the practice was legalized and regulated. Bankers agreed to abide by limits on the amount of fictional loan money that could be lent out. The limit would still be a number much larger than the actual value of gold and silver in the vault. Quite often the ratio was 9 fictional dollars to 1 actual dollar in gold. These regulations were enforced by surprise inspections. It was also arranged that, in the event of a run, central banks would support local banks with emergency infusions of gold. Only if there were runs on a lot of banks simultaneously would the banker's credit bubble burst and the system come crashing down.
Okay, the central bank, that is the Federal Reserve in the United States. That's our central bank, and that's the function that they do.
Over the years, the fractional reserve system and its integrated network of banks backed by a central bank has become the dominant money system of the world. At the same time, the fraction of gold backing the debt money has steadily shrunk to nothing. The basic nature of money has changed. In the past, a paper dollar was actually a receipt that could be redeemed for a fixed weight of gold or silver. In the present,
This is the old way that money, you guys remember bills like this? There's still bills floating around like that. It says in silver, it's payable in silver to the bearer or in gold. And then usually that symbol on the side that's green is either blue or red or even gold in color. If you ever find any of those, snag it up.
Present, a paper or digital dollar can only be
This symbol right here is usually where you see it in gold. In green. If you ever see it in red, blue, or gold, keep that in your wallet and don't spend it. That's a redeemable certificate for its face value for that precious metal. Now, money today is issued from the Federal Reserve as a note, comes from the central credit of the bank. And it says this note is legal tender for all debts, public and private. That means it needs to be accepted by everybody. Otherwise, you can't sue somebody and force them to pay you money if you don't accept the type of money that's available.
Redeemed for another paper or digital dollar. In the past, privately created bank credit existed only in the form of private banknotes, which people had the choice to refuse, just as we have the choice to refuse someone's private check today. In the present, privately created bank credit is legally convertible to government-issued fiat currency, the dollars, loonies, and pounds we habitually think of as money. Fiat currency is money created by government fiat or decree, and legal tender laws declare that citizens must accept this fiat money as payment for debt, or else the courts will not enforce the obligation. So now the question is, if governments and banks can both just create money, then how much money exists? In the past, the total amount of money in existence was limited to the actual physical quantities of whatever commodity was in use as money. For example, in order for new gold or silver money to be created, more gold or silver had to be found and dug out of the ground. In the present, money is literally created as debt. New money is created whenever anyone takes a loan from the bank. As a result, the total amount of money that can be created has only one real limit: the total level of debt. Governments place an additional statutory limit on the creation of new money by enforcing rules known as fractional reserve requirements. Essentially arbitrary, fractional reserve requirements vary from country to country and from time to time. In the past, it was common to require banks to have at least $1 worth of real gold in the vault to back $10 worth of debt money created. Today, reserve requirement ratios no longer apply to the ratio of new money to gold on deposit, but merely to the ratio of new debt money to existing debt money on deposit in the bank. Today, a bank's reserves consists of three things: the amount of government-issued cash that the bank has in its vault, the amount of credit it has with the central bank, and the amount of already existing debt money the bank has on deposit. To illustrate this in a simple way, let's imagine that a new bank has just started up and has no depositors yet. Investors have paid for the bank's infrastructure and have supplied it with sufficient cash to meet the demand for cash withdrawals. Typically, cash in the vault will amount to no more than $1 for every $20 or $30 that could be demanded from the bank. The bank has joined the central bank system, which permits the new bank to borrow cash from the central bank if it's needed. The doors open, and the new bank welcomes its first loan customer. The customer needs $10,000 to buy a car. On approval, the bank creates an account for the borrower and types in that the bank owes the borrower $10,000. This $10,000 is not taken from anywhere. It's created on the spot. The borrower does not take this money out in cash. Instead, he writes a check on his account to buy the car. The seller then deposits this newly created $10,000 check at her bank. At a ratio of 9-to-1, this new $10,000 deposit allows the seller's bank to create a new loan of $9,000. And if that $9,000 is then deposited by a third party, it becomes the legal basis for a third issue of bank credit, this time for the amount of $8,100. Like one of those Russian dolls, each layer of which contains a smaller doll inside, each new deposit contains the potential for a slightly smaller loan in a decreasing series. Now, at any stage, if the money created is taken out in cash and not deposited at a bank, the process stops. That's the unpredictable part of the money creation mechanism. But more likely, at every step, the new bank credit money will be deposited at a bank, and the reserve ratio process can repeat itself over and over until almost $100,000 of brand new bank credit money has been created within the banking system. All of this new money has been created entirely from debt, and all transactions have been carried out with bank credit. None of the banks involved have needed to use any of the cash in their vaults. What's more, under this ingenious system, the books of each bank in the chain must show that the bank has 10% more on deposit than it has out on loan. This gives banks a very real incentive to seek deposits in order to be able to make loans, supporting the general but misleading impression that loans come out of deposits. Now, it can't be said that any one bank got to multiply the initial $10,000 of bank credit into $100,000 of bank credit. However, the banking system is a closed loop. Bank credit created at one bank becomes a deposit in another, and so on and so on. In a theoretical world of perfectly equal exchanges, the banks would owe each other nothing at the end of the day, and the $10,000 created out of thin air as a loan by the first bank could indeed become almost $100,000 of new loan money in the banking system. If that sounds ridiculous, try this. Actual reserve ratios can be much higher than 9-to-1. For some types of accounts, 20-to-1 and 33-to-1 ratios are common. There are also many exceptions where no reserve requirements apply at all.
All right, that's where we're going to leave this video at, but it was pretty informing video here. I don't know if you guys agree at all, but you learn something about the banking and how lending works by watching that video.
Absolutely.
Yeah, that was only about 16 minutes into the video. You still got another 40 minutes of it. But isn't it interesting how the way that he put it together as a cartoon made it entertaining to watch and easy to understand, how banking works, how money gets its value, how lending works. They give you an example how you open a bank and how it works, how the Federal Reserve works as well.
What's the name of the movie again?
It's called Money as Debt, Promises Unleashed. And I shared that video with you in the chat window. You have the link there in the chat window, so directly to the YouTube video, so you could watch it if you want later. Okay. All right, so conventional loans are directly between the borrower and the lender with no third party involvement or influence. Okay. Because there's no third party that's going to be buying the loan. So there's no lending criteria from some third party that they need to base lending you money on, because they're not planning on reselling the loan. So you get them from portfolio lenders or conventional lenders who keep these loans within their own investment portfolio. That's where they get the name portfolio lender from. Okay. Now, don't confuse them with conventional loans, which are conforming loans. Conventional loans conform to third-party lending guidelines. Okay. Conventional and conforming, don't mix them up. They're two different things. Conventional loans, you get them from portfolio lenders. They don't resell those loans. Conforming loans, on the other hand, these ones are types of loans that meet third parties lending guidelines. So the lender has the final say in who they lend to because they're the one that's lending the money. So they could be more flexible when they don't have to conform to some third party's arbitrary lending guidelines. They make the final decision. Now, this doesn't mean you take your clients that have piss poor credit score and a bad history of paying back their debts so they have trouble getting loans. You don't take them to portfolio lenders to get a conventional loan. Ain't gonna happen. Would you risk your money lending it to somebody like that? No. So neither will they. They're not stupid. But what they'll do is sometimes people have trouble getting loans because maybe they own more than 3 houses, or they their debt to income ratio is beyond the limits of a particular lender's lending criteria. But this person's got like an 800 credit score. They've never missed a mortgage payment. They own like a bunch of houses. And so therefore they don't fit into the lending criteria for most loan programs. You could take them to a conventional or portfolio lender. They'll evaluate the situation and they'll see, yeah, it's not a big risk. We'll lend our money to them. Okay. I have a friend that had a trouble buying a 2-family house for $200,000. He was trying to get a loan for $200,000. He was buying a $200,000 house. It was about 220, something like that. He owns a bar. He owns about 15 rental properties. Never laid on a mortgage payment. His credit score was like 840, and he couldn't get a $200,000 loan to buy a 2-family house that the rents would more than pay for the mortgage. So, because most lenders' lending criteria, they plan on reselling those loans. They have to follow some third parties' lending criteria that he didn't fit into any of the categories. So I took him over to a portfolio lender. At the time, it was RSI, Rawway Savings Institute. Since then, Columbia Bank bought them or merged with them or whatever happened there. But they're a portfolio lender. They examined the situation. They said, we see what's going on here. Yeah, this guy, he's an investor. Yeah, we're used to this. He's an investor. What they do is they usually have a lot of write-offs on their taxes too, so they don't have to pay as much taxes. But now when you analyze their debt to income ratio, it looks like they're spending all the money that they're making. You know, and that was my friend to a T because he's cheap. Go ahead, say, how cheap is he, Vic?
How cheap is he, Vic?
He's so cheap that when he goes to Home Depot and sees a receipt floating on the ground, he picks it up so that he can write it off on his taxes.
What?
Yeah. But the thing is, if you have too many write-offs, that could backfire on you like it was with him. It looked on paper, like when he filed his taxes, like he was spending every penny that he was making. So he tries to get a loan. Most lenders are like, how are you going to pay us?
Right.
It looks like you're spending every penny you make already. You're overextended. Your debt to income ratio is out of whack. So that's why I took him to these portfolio lender and they gave him the loan and he bought the house. So now a maximum seller concession allowed for a conventional loan is 3% of the loan amount. The down payments required are usually larger. Usually at least 20% down payment is required for conventional loans because conventional banking theory says that if a lender loans more than 80% of the value of the property, that they're risking their depositors' money. Okay. which is why they need to be insured and carry private mortgage insurance, which we're going to get into in a moment. Actually, we're going to get into it right now. If the LTV is higher than 80%, meaning the borrower puts down less than 20% of their own money, the borrower would be required to pay for something called PMI. That's private mortgage insurance. So what does PMI insurance insure? It does not insure the entire loan amount. It only insures the amount of the down payment less than 20% that the borrower put down. So if a borrower put down 5%, PMI insurance would cover 15% of the loan. It would insure 15% of the loan. That amount less than 20% that the buyer did not put down. That's all that it covers. So here's a few portfolio lenders if you want for your own convenience that are local. You could find out easily how a lender is a portfolio lender. A lot of times you could ask them, but the mortgage reps don't know. They'll tell you, yeah, we're a portfolio lender when they're not. Just driving by construction sites, that for a construction project, it's not normal. It's a high rise, it's a huge apartment complex or something. Those aren't normal projects. So if it has a sign or a billboard or a banner there that says this project is funded by, they are a portfolio lender. It's the easiest way to tell. Okay. Other than applying for a loan through them and asking them directly if they're a portfolio lender. But Amboy Savings Bank, PPAC, Gladstone, Provident, Unity, Columbia, and yes, even Santander is a portfolio lender, but they generally do not lend for smaller projects, only the bigger ones. Their own money anyway. So PMI insurance, I got a slide here all about it for you. If you guys want to snap a pic of this, it gives you everything you need to know. We'll be highlighting this stuff in the book, but it's a little disjointed in the book. Private mortgage insurance insures any amount less than 20% the borrower put down when purchasing. So if the borrower puts down 5%, PMI insurance insures the other 15%. Now, when equity reaches 20% in the property, PMI insurance can be dropped at the borrower's request. Lenders are required by law to drop PMI insurance by law when equity is greater than 22%.
How do you does the lender require to refinance, or they just drop it that particular amount just because
Well, no, you're keeping the same loan with them, but you're paying for insurance on that loan because you made a down payment less than 20%. So you have to carry this insurance for that amount. So when your equity reaches 20%, because that's all PMI insurance insures, it's the only purpose of it. When you reach equity of 20% at your request, if you're keeping tabs on it, they'll drop it. But if you don't request it, they'll keep charging you for PMI insurance until your equity reaches 22% because they're allowed to by law. But
how do they calculate the equity of the house?
Good question. How do they do that? Well, they could get an appraisal, but appraisals are expensive, so they usually don't do that. So what's another way banks get valuations of properties? Guys?
Wait a minute. Something market analysis.
They come to us for what's called a BPO, a broker's price opinion. They'll pay real estate agents to give them a valuation of the property in what's called a broker's price opinion. It's a little bit more advanced than a CMA, the comparative market analysis that we do for buyers and sellers to determine the value of their homes. A little more math involved in it. It's not an appraisal because it's still coming from us, but it's a way that we value properties for lenders and they'll pay us for it. Okay. And they'll see if the property, how much equity it has, based on the market value of the property, the current market value based on your report, and determine whether they have 22% equity or 20% equity. Now, what does PMI
Do we know
insurance
the
cover?
formula to calculate the equity of the home for the 20%?
Well, it's based on the value of the house and how much. Here, hold on a second. Let's skip down to the bottom of this slide.
Thank you.
What is equity? Equity is the difference between the current value of your property and what is currently owed on it. At the time you purchase your house, your down payment amount is how much equity you have in it. So if you only put down 5%, you have 5% equity. But equity can increase in several ways. You could do improvements to your house, increasing the value of the home, building up the equity, right? The difference between the market value and what you owe on it. By doing improvements, you're raising the equity. Or by paying down the loan. When you pay down the loan, you're increasing the difference between what you owe on the property and what the market value is. Or just through natural fluctuations in market values. Market values are cyclical. They go up, they go down. If you're in that upswing cycle, the market values are just going up and you did nothing to the house. It's just the market value is going up in an area because of supply and demand and other factors. That's the ways that equity can go up. Okay. So there's three general ways that equity goes up, and those are them. So then they would order a BPO from a real estate agent or brokerage. And if they have that much value versus the market value in comparison to how much they owe on the loan, that is the equity. That's how they determine equity. Okay. What the current market value is and how much is owed on the loan. If there's a 20% difference there, that's it. Okay. They could drop it. However, they usually don't drop it unless you request it. They keep charging you for the insurance because, hey, it's more to their bottom line. What is PMI insurance insuring at 21% equity or 22% equity? What is that insurance coverage covering? Nothing. You're paying for insurance for nothing. But the lenders are allowed to still continue charging you insurance until equity reaches 22%. Why? Because there are fluctuations in market values. Just to be sure, they give them a little leeway. The government gives them a little leeway. That's why you should keep track of your own loans. If you have a conventional loan, you have PMI insurance, you should check and see what your current market value is versus how much you owe left, how much is owed on your loan. And if there's a 20% or greater gap, you could request they drop that PMI insurance. Okay. It's not life insurance, and it does not insure the entire loan amount, only the amount less than 20% that the borrower put down. Now, if you get a loan through the FHA has something called MIP, same letters, just scrambled up a little bit. That stands for mortgage insurance premium, and this does insure the entire loan amount. Remember, the FHA tells local lenders, lend them your money because the borrower meets our lending criteria, and we will insure you against loss. You won't lose a penny if they default on the loan. Okay. So the FHA insurance called MIP insures the entire loan. PMI only insures the amount of the down payment less than 20% that a borrower put down. When can you drop it? When equity reaches 20%. When must it be dropped? When it reaches 22. There you go. Everything you need to know about PMI and when you could drop it. And that MIP insures this entire loan. So let's highlight this stuff about PMI in the book. And here's the explanation about market value and how it's determined. They usually get it by getting a BPO, broker's price opinion, or in some cases a CMA or Actually, no, BPO. Lenders use BPOs. They just explaining here that CMAs are similar to BPOs in that they should not be considered appraisals. Why can't we do appraisals?
We're not licensed.
We're not licensed appraisers. Only licensed appraisers can give appraisals. We help consumers and lenders determine values of properties by doing BPOs and CMAs. Okay. And remember, if a lender pays you to do a BPO, it still needs to be paid through your broker. You don't get paid directly. That's a no-no if you do.
Oh, wait a minute, this July 20.
When you start interviewing brokers, ask them, if I do BPOs for banks, can I get paid that full amount or does that still need to be split? I know I need to get paid through the brokerage, but do I get paid the full amount or does it still get split like commission? Some brokers for things like that, they'll allow you to get paid the full amount because the work involved and how much you're getting paid on a BPO, you know, it's good extra money, but it's not a killing, you know. So hopefully your brokers don't take a chunk out of it, but it still is commission for real estate work, so they may. Everybody got those highlights, those notes? Everybody good?
Yes.
Okay. Now we're going to learn everything we need to about FHA loans. First, snap a picture of this slide. Take a screenshot. This is everything you need to know on one page. After I go over this, we're going to do some highlights in the book across maybe about 3 or 4 pages. This is spread out all over. Okay. But this is everything about FHA loans. What is the FHA? Well, it's the Federal Housing Administration, and their website is fha.gov. Actually, that's more of just a consumer end website now. I think Biden put that up. There's not much information. As a matter of fact, I think it forwards now. It didn't even stay up. The FHA.gov, you go there and it forwards you to mostly links that are on this page on the HUD website. Okay. Enterprise.hud.gov. So the FHA insures loans, but they don't lend money directly. They insure the lender if the borrower meets their lending criteria and the property they're buying meets their lending criteria. They say, lend them your money and we will insure you against loss. That's what they tell the lender. Now, these loans are for purchasing or refinancing owner-occupied 1 to 4 family homes. They are not for investors. These are only for 1 to 4 family owner-occupied homes. Okay. FHA 203B is their most popular loan program. It's a fixed rate loan. But you could get other loans through the FHA. Adjustable rate mortgages are available. Improvement loans are available. We call those, different construction loans, like the 203K down here at the bottom, the FHA 203K. This is one loan to purchase the property and for extensive rehabilitation, to do work, to put an addition on the house, to remodel a kitchen, things of that nature. But the 203B is their fixed rate loan. It's the most popular loan program. It's enticing to the public because it requires a low minimum down payment requirement of only 3.5%. So the LTV is 96.5. It used to be 3%, but President Obama raised it to 3.5% after the mortgage meltdown. But then when it came to his reelection year, he temporarily lowered it back down to 3%. Why do they do that? It's games politicians do. They try to make the economy seem better, to get more people out there to buy houses while the down payment requirements lower. It's just gamesmanship when they do elections. Their presidents are limited on what they could play around with. So he played around with that a little bit, lowered the interest rate back down after he raised it during the election year to try to get more people to go out and buy houses. And then after the election, 3.5% down payment came back. Like, you can notice like little things like this. These are like little games that politicians do. Now, have a minimum repair. These do have a minimum repair requirement, though, the 203B loans. The property needs to be in livable condition. It needs to be in move-in livable condition, not requiring a lot of repairs. You cannot use an FHA loan to buy a house that needs a lot of work. A lot of people say, hey, it only requires 3.5% down payment. That's perfect. I'm a contractor. I could do work. I could fix it up myself. Yeah, you're not going to be able to get a loan to do that because the FHA is looking out for the consumer. Why do people get FHA loans instead of conventional loans?
It's easier to get it.
What's the minimum required down payment usually for conventional loans?
20%.
Yeah, 20%.
20% down. Significantly more money. So why are you getting an FHA loan? Because you don't have enough. You don't have a lot of money. So the FHA looks at it in this way. Because you don't have enough money, how are you going to be fixing up the property after you buy it if you don't have a lot of money? So they don't want you. They consider it looking out for your best interest by not letting you buy a house that needs a lot of repairs with their program that requires a low down payment. However, if you want to buy a house that needs a lot of repairs, you could use a different loan program that they have, which is the 203K. You can still buy the house. You're just going to need a different loan, the 203K. The interest rates on them may be a little bit higher, okay? Because they're not just lending you money to buy the house, but also the money to do the improvement to the house. Now, they're not going to give that money to you, that extra cash, and hope you do the repairs. Okay, so there's certain guidelines on how that works. We're not going to go over them here in class. There's a lot of lenders that have classes to teach you about the 203K loan program. You may even be able to find out about it. There may be available online for you that you could a video you watch. So look, put that down in your notes. Look up education class on how education class for real estate agents, how FHA 203K loans work. You may be able to find videos for it online and not have to go to an event. But if you go to one of these events hosted by the lenders in a hotel somewhere, they'll probably have this. They're going to give you a bag of all kinds of goodies too. Get some free stuff from them. All right. So getting an FHA 203B loan requires an upfront mortgage insurance premium, MIP, which insures the entire loan amount for the lender. So if you default, if the borrower defaults, the entire loan is insured. So this insurance is charged at closing, or it can be wrapped in the loan itself, which insures the entire loan in case of default. And that does not make sense, but that's the way that government thinking works. You figure the person's making a small down payment. So therefore, they don't have a lot of skin in the game. So we need to insure this loan and charge them insurance for the loan. However, that insurance needs to be paid up front. They're just kidding. If you don't want to pay it up front, you could wrap it up into the monthly payments of the loan itself and finance that upfront loan payment. Oh, this is the way government thinking works. Okay. You don't have to pay for your car insurance until you get into an accident. There you go. That's the way it works, right? Imagine if it worked like that. That's basically what this is. So The monthly MIP payment is also required, can be dropped only when equity reaches 78%. Now, President Obama changed the rules on this too. Now, most people are not going to be paying off 78% of their loan in after 11 years. But if they do, they cannot drop the loan anymore, because President Obama made some changes here. He said that you could only drop the MIP insurance when equity reaches 78% of the loan, but only after you've had the loan for at least 11 years, and only if you put at least 10% down when you bought the property. Now, how much does the FHA require as a down payment?
3.5%.
So how much do most people put down? 3.5%, the minimum.
Right.
Maybe a little bit higher, maybe 5%, but it's still not 10. And because it's not 10, most people can never drop this coverage anymore.
Right. Wow.
Now, can anybody explain to me or think up, why would President Obama do this? This makes this loan not good to be in for the long term. Why would he do that? Because he wants you to use the FHA loan to get into housing. But to refinance it into a conventional loan as soon as possible and get the hell off the FHA insurance program for these loans. Because when we had that mortgage meltdown, it cost us two huge bailouts that we did to pay off all these lenders where borrowers were defaulting on loans when the values were dropping like a brick. The government was insuring the loans for the full amount of the value that they lent them. Now that the properties are worth less than half, they wouldn't be able to sell it at auction and get that money back. So the FHA program foreclosed on that, took those properties, and then they paid back the lender the full amount that they originally borrowed. As you can imagine, with half of the loans out there being FHA loans, this was a huge amount of money. The FHA program went bankrupt. So President Bush had to do a bailout. And during that bailout, there was a lot of politicians on his own party that were saying, don't do this until we put some rules in place on how that bailout money can be used. He put it out there right away anyhow. A lot of lenders had we learned about terms called golden parachutes, right? I'll explain that in a moment. So all that money got used up paying back lenders for these FHA defaulting loans. Then President Obama came into office and did a second larger bailout. Once again, the politicians were like, no, we can't do this. We learned for the first time that when we don't put rules in place, this money is going to be riddled with waste, fraud, and abuse. We're going to have bank CEOs that are getting huge golden parachutes as bonuses. Okay, so basically, how do CEOs earn bonuses or higher ranked people in the banks? Based on the money that's in their coffers. Because under normal banking business, that money's there because they're successfully writing loans and doing business, and that's their profits. However, now they're getting all of this money all at once because people are defaulting on loans and the FHA is paying them. So they got all this money now sitting in there from the FHA program. And those CEOs got their bonuses based on the amount of money that was sitting in their bank accounts, because that's essentially their profit. And during this mortgage meltdown, they stopped lending as much. They weren't lending as much. CEOs were getting paid these huge bonuses that they ended up retiring off of. They called them the golden parachutes for them to retire off of. And that's what happened. But politicians will probably do it again sometime in the future. They'll offer, if this ever happens again, they'll offer these bailouts, these government bailouts to these banks that are too big to fail. And hey, if you write bad loans and you write a lot of them, you deserve to go out of business if you can't cover the cost. Why should the taxpayer foot the bill? But anyway, the monthly MIP payment is also required and can be dropped only when equity reaches 78%, but only if they had it for 11 years and put down at least 10% at the time they got the loan, which most people do not do. So the maximum seller concession allowed, that's money that the seller gives back to the buyer to help with the closing cost or for repairs, is 6% of the loan amount. Now, this is a good tool. You guys are probably going to use this a lot. I've used it a lot, where I asked for sellers' concessions to make the deal happen when the buyer doesn't have all the money. Now, borrower may also be able to finance some of the closing costs as well. So any or all of the down payment and closing costs may be a gift, not a loan from the buyer's relatives. Why not a loan? Because if it was a loan, they would have to factor that into their income, debt to income ratio of how much they could afford to borrow, because that's another payment they would have to make, right? So they could get it as a gift and not a loan. As a matter of fact, the FHA and the VA would require that the relatives that are lending that money or giving that money sign a document saying this is in fact a gift and not a loan and does not need to be repaid. So they better trust those relatives. If it was a loan that they're writing off as a gift, they better trust them. FHA loans before December 15th, these older FHA loans before December 15th, 1989, are assumable by anyone. But those made after this date, the buyers assuming the loans must qualify for them in order to assume them. The 203K program, FHA 203K, K for construction, is their construction loan. I know that's not how you spell construction, but you could pronounce it that way, right? So 203K, K for construction. That's the way I remember that that's the construction loan, okay? Told you, I got silly ways of remembering stuff. It may work for you, it may not. It's what works for me. K for construction. That's actually not a new construction loan. It's a rehabilitation loan. For doing extensive rehabilitation work on the property. So if you want to buy a house that needs a lot of work using an FHA loan, you could do it, but you can't use the 203B program. You got to use the 203K for construction. What's the matter? Wants to go out and play with the squirrels? Okay. The amendatory clause that must be added to all contracts for purchasing properties that are using FHA loans says that if the house does not appraise for the purchase price, the buyer can get out of the contract without penalty. All right, so there we go. Everything we need to know about FHA loans. Almost. FHA has loan limits on how much you could borrow to purchase a 1, 2, 3, or 4 family house. And it depends on the county that you live in. Here is the guide for it. FHA loan limits by county. I could click on that link. And it takes us here to the HUD website. Check out how this works. Let's select by county. Let's select New Jersey. And we could even put in a city. Well, let's just look at New Jersey as a whole. Separated by county, because we have richer counties and poorer counties. Here's the median sale price in that county. Here's how much a 1, 2, 3, or 4 family house you could borrow to buy a 1, 2, 3, or 4 family house from the FHA. In Atlantic County, it's one of the cheaper counties. So for a 1 family house, they'll lend you up to $730,000. That's a cheaper county? Damn. Well, there is even cheaper than them. Burlington. 1 family house, they'll lend you up to $630,000. When I got started in the business, looking at numbers like this, we were looking at mansions. And I got started in 2004. you know, wasn't that long ago, maybe 20 years or a little bit over 20 years ago, but look at this. 630,000 for one family, 806 for two family, 975 for three, or 1.2 million for four family. But in one of the more expensive counties like Bergen County, for one family, they'll lend you 1.2 million, 1.6 million for two family, 1.9 million for three, and up to 2.4 million for a four family house. So you can look and see wherever your client, whatever county your client's looking to purchase a house in, these are the maximums that they could get a loan to buy a house for. Oh, here's a cheaper one, Mercer County. Average home value is $391. For one family, they'll lend you a little bit over a $500,000. Two family, three family, four family. Wow. Wow, wow, wow. All right, so that's the way that that works. Now, if you're buying a condominium, the FHA will only lend you money to buy a condo in an FHA approved condominium complex. What makes it FHA approved? Well, they have to use certain minimum standards of construction materials. And the majority of the units need to have already been sold, with the majority of owner occupants, not renter occupants. Because who takes better care of a property? The owner, not a renter, right? So you got to check, see if they want to buy a condo, see if the condo complex is approved for FHA loans. So here is the link for that. So we'll look it up in New Jersey. And let's look in Middlesex County. What city has a lot of condos? Woodbridge, Edison.
I would
Here,
say,
let's look up.
say Woodbridge.
Okay, let's look up Woodbridge. Let's see how many condo complexes in Woodbridge are FHA approved. So here are the condo complexes. What? That's a pretty short list of condos. It used to be FHA approved. FHA approval is required every 20 years. So it has about a concentration of FHA loans of 1.33% of the units there. Apparently, somebody tried to get it approved in 2024, and it was rejected for some reason. It used to say why, what the reason is. Over here, it's not saying it anymore. It looks like they changed this around a bit. So look at all these complexes. They have some FHA loans in them. At one point, they were approved for FHA loans. Let's see. This one is rejected, 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 expired, expired, rejected, single unit approval. All right. Any other complexes, they would need to submit a package, or even these complexes, they could still get reapproved for FHA loans. However, it has to be majority owner occupants, not renter occupants. We know that the construction standards meet the minimums because they at one point had FHA approval. But they also look at the finances. They look at the percentage of owner occupants versus renter occupants, and the insurance that the complex has. And they look at various factors like that to determine if the complex is going to be approved or not. So sometimes people submit packages that are incomplete, and then they get rejected for that reason. Or maybe they get rejected because they're just no longer meet the FHA's requirements. I don't know. So let's go back. Let's look at Edison. Edison got a lot, right? Let's look at Edison. How many FHA approved condo complexes are there? Oh, rejected, expired, expired, withdrawn, expired, rejected, expired, 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 rejected, 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 expired, 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 withdrawn, rejected, expired, rejected, rejected. None. Right now, you're not getting an FHA loan to buy a condo in Edison or Woodbridge unless you submit a whole package for approval and it gets approved. See, I know that a lot of these previously said that they were rejected because the complete package was not submitted for approval. You could just get your the finances, the HOA guidelines, and the management to fill out the application and then submit that along with the loan papers to get the complex approved. It doesn't take that long. It's not that difficult, but apparently a lot of people don't want to wait so long, and then it may get rejected because they want another piece of information. So it's pretty easy now to get conventional loans that require lower down payments now. So you don't necessarily have to wait around for the FHA loan. So this is why a lot of people are not. So why these complexes are not approved any longer. They were approved at one point in time. They need to be reapproved every 20 years. And somebody just needs to stick in there long enough for these complexes to be able to get FHA approved. Now, I remember one time I met with this lady and her whole family. Her son was looking to buy a condominium in Perth Amboy. But the mother was doing all the talking for him. You know, he didn't even come to see the unit. The mother and her sister and their kids and like all these people that have nothing to do with purchasing this property came to see the property for the son. And I was like, okay, did anybody bring the mortgage approval letter? And the mother was like, yep, I got it right here. She pulled it out of her pocketbook, folded it. She's like, here you go. It's a mortgage approval letter. And I'm looking at it. It's for an FHA loan. I said, you can't buy in here. And she's like, what do you mean I can't buy in here? I said, this complex isn't FHA approved. This is for an FHA loan. So you're not going to be able to buy in here using this loan. You'd have to get a different type of loan. And she's like, don't tell me where I can buy. And all of a sudden, I'm a racist. This became like a huge racist argument, you know, and I'm like, don't shoot the messenger. I want to sell you something. Otherwise, I wouldn't have opened up the lockbox to let you in and set up the appointment. It's not even my listing, you know. I came here to represent you. Why am I discriminating against you? You know, it doesn't make sense. And then they all started talking, oh, he's discriminating. The white guy's discriminating. I'm like, don't you people get this? It is an FHA loan your son was approved for. This complex is not FHA approved. So you would need to get a different type of loan to buy this unit. And they didn't want to hear anything from me. All it was screaming at me how I'm a racist because I wouldn't let them buy a house in here. So I was like, you know what? Enough. It's not my listing. But even if it was, I need to safeguard that place. So I was like, everybody out. I had to start shouting at him, get out. You people don't belong here. It's your son that's shopping for a house. If he wants to buy a house, he needs to contact me, not his mama and his extended family. You know, this boy needs to be responsible. If he's buying a house, he needs to make the effort to buy the house. I'm not meeting with his mother or anybody else anymore, you know, especially if you guys are going to be causing this nonsense. I said, I need to speak to the buyer. Okay. I was like, so for now, everybody out. And I got him out, locked the door, got the hell out of Okay. I
This
don't want to
sounds
be
like a,
responsible for any
sounds,
damages they did. Even though
sounds
it's not my listing, I'm still responsible for what happens in there, and they were getting a little crazy.
it sounds like a lack of knowledge. It probably wasn't the race thing. It's just that this kind of information,
Listen, I
I
understand.
can speak for black people. This kind of plethora of information.
It's not a black people thing. Listen, most black people don't act like that. It's an education thing. It's
Yeah.
upbringing. Sometimes people got this chip on their shoulder that they've been like brainwashed that everything, if things don't go your way, it's because somebody's being racist against you. Okay, I understand that's certain people. I it's not a black thing. It's a certain black person. I'm not blaming a whole race for the way somebody acts. But there's people like that you're going to come across in the business. Okay, you come across them in real life. I'm sure you come across them too, right? You
Yeah,
know exactly what I'm
yeah,
talking about.
I'm not saying, I'm not
Yeah,
assuming that because you didn't say what race they were.
yeah,
It could have been any race of
yeah,
people
yeah,
or any class of people. It's
yeah.
just, it sounds like the missing piece was the understanding between the differences in the loans, because most people feel like I go to the bank, I'm gonna get a loan, so I should be able to buy whatever I want, not realizing that your qualifications to get a specific loan that meets a certain criteria is afforded to you to put you in a certain category.
I
Nobody, they don't understand
I
that.
I tried explaining that to them. I mean, this wasn't like a shocking issue. I'm used to this kind of stuff because look, some complexes they're just not FHA approved. What are you going to do? You either got to buy somewhere else or you got to get it approved for a different type of loan, and you could still buy in here. You know, but um, like she just flew off the handle.
Yeah.
Like
So now it
like
sounds like, your thing, the chip and the whole thing now. But I'm just saying,
yeah.
generally, your general consumer does not really know all of these details. Even when they go and sit at the bank and
And that's our job to educate them in that. And that's
yeah,
what I was trying to do. I was trying to explain it to her, but she didn't want to hear it. You know,
the
and
most consumers, they just want to know, could I get it and could I afford it per month? They don't care about the details.
oh yeah, I know
Like
that.
I used to be a loan manager for New Jersey Transit. So I worked in the credit union. And what I learned from the other side, it changed me as a consumer.
Yeah.
And so what interest, I'm a enemy to interest. I'm like, I'm gonna pay
aren't
fast.
aren't we all? Who wants to pay interest?
Yeah.
Okay. Well, yeah, our job is to be a good agent. I keep telling you guys to be a good agent, you have to educate the public. But sometimes people don't want to be educated. That's the instance that I came with here. I tried to explain it to her, and I sat there for quite a while trying to explain. Come here, let me explain this to you. This. They didn't want to hear an explanation or anything. All they heard was you can't get in here, and after that, it was like nothing I said was coming across. So sometimes if you come across people like that, you got to realize, cut the cord. There's nothing you could do. Just move on. So that's what I did. I tried to explain it. I was there for almost a half an hour trying to calm her down so I could explain it. And then after a while, I was like, you know what? This is bullshit. Get out. Everybody out. And then I locked up the place and I got at Dodge. And I was like, what a colossal waste of time that was. Especially when you got somebody who's a family member and not the person who's actually purchasing the house, putting in the effort to come look at the house. I get students like that sign up for these classes. And right off the bat, I know they're not going to complete this course if they bother even showing up. I've had plenty of parents. They're like what do you call them? Helicopter moms. They contact me. They do all the research for the kid. They contact them because he's not good. He's not going to college, but he wants to do something. And this is a good career move for him and everything. He wants to do this. And I'm like, okay, well, this is what I'm thinking. I'm not saying it to the mom, but I'm like, all right, then why are you calling? how come your son's not calling me? Isn't he adult? You got to be an adult to get this job, to get a license. So right off the bat, that those people they don't have the gumption that you're going to need, that's required in the real estate industry to get up and do the work. You have to be a go-getter. If you're not a go-getter, if you're hoping for other people to put the business in your hand and it's just going to come to you, I'm going to tell you right now, quit this class. You're going to fail in this business. Okay. You need to be able to handle simple tasks without somebody directing you every step of the way. Do this, do that, do that. After you learn them, you'll get training at the beginning. But after that, you got to be able to get up and be the go-getter yourself, So like the ones where they can't even sign up for a class themselves, they need their mom to do it for them. I usually get a pretty good idea that these people usually don't even show up. And it happens more often than you think.
Wow.
Okay, let's look at the HUD-owned homes. When FHA forecloses because they insured a loan for a lender, the FHA will foreclose on that borrower, take the property, and then they turn it over to HUD. And HUD deals with disposing of those properties. They'll usually hire a real estate agent or they'll have an auction. They often have these HUD auctions. And if the properties don't sell at auction, what do they do with them? They offer them as $1 homes that you could purchase for $1 if you're a teacher, police, or fireman. These homes are available for $1. Wow. Now they're also available to other community groups for $1 as well, with all the illegal immigration and need for getting people in housing and stuff. You had local governments that were buying that up, and as well as these community outreach groups that try to house people, that it's opened up to them now because of all that for $1 as well. So let's take a look, though. It's hudhomestore.gov. And this is their website, hudhomestore.gov. By the way, if you're ever going to make an offer on a HUD listed home, you need to be a HUD approved agent. Your brokerage needs to be HUD approved. So when interviewing your brokers, ask them, is their agency HUD approved? Or is the broker HUD approved? Because you could only become HUD approved if your broker is. And then you need to take a class on how to submit offers, because they got specific ways they want to do things. Contracts need to be done in blue ink, not black ink, not any other color ink. They need to be FedExed overnight if their offer is accepted through the electronic system. Okay. And anyway, here you can look up and see by any city, state, zip code, you can look up and see all the HUD homes that are available. Here's the different programs they have. Good Neighbor Next Door program, HUD approved nonprofits, and the Dollar Home programs. Let's look at all of the listings. It used to be that you could click on any state or hover over any state, and there are hundreds, if not thousands, of HUD homes available. Now, you'd be lucky if you find any. And that's because a lot of these groups are just eating them up for $1. Look, New Jersey has only 11 homes. Let's click on it. Let's look at the 11 homes, which that's more than the last time I looked. There we go. Here's one for $550,000, a ranch-style house in Gladstone. Ooh. Peapack Gladstone area, that's money. That's actually pretty good price in that area. 3-bedroom, 1.5 bath. Okay. Now that's the asking price. It goes to bid at auction though. $410,000 in Galloway for this one. Oh, that looks like a pretty new house. That's not bad. Oh, it's only 2-bed, 2-bath in Atlantic County. $390. And Highland Park, Newark, 380. The house looks like it needs a bit of work though on the roof there. All these homes that are HUD homes usually need work though. Usually, not always, but usually. This one doesn't look that big, but it says 4 bedroom, 2.1 bath,
Go back
340.
to that one in Newark. Go up, down a little bit. That's
This one right here. Yeah.
Vassar. Yeah.
152-154 Vassar Avenue. 3 beds, 1.5 baths. Looks like the siding's a little beat up and the roof may need some work too. But these HUD homes usually do. Look, they were foreclosed on because people weren't making payments. You think they were maintaining them? You know? That's why you get good deals on them, like buying them at auction.
I can see those two lines on that Newark house.
The 2 lines, which ones?
Yeah, the white ones. It means they have completed, finished their loan.
Where do you see the lines? What are you talking about?
The white
In the
symbols.
picture?
Yeah. What does it mean?
Where do you see the white symbols, white lines? I blew up the picture. Can you see it?
Yeah.
Are you talking about these things in
No,
the
no,
window?
no. These sculptures, white lines.
Oh, the
Lion.
white lions. Oh, the
Lion.
lions. That's just a decoration a lot of people put out there, I guess.
It's a decoration, or it has some meaning. I have heard that when you finish your loan, then you can place these lines in
Oh
front of the
no.
property. No?
Maybe in some cultures it does. Others it could just be a decoration. Hey, the lions look cool. I don't know. It depends on the persons that were there. Don't read too
Oh,
much into it. People do
oh,
some wacky stuff.
okay.
Wow. Look inside.
Need some light fixtures. You just got wires dangling there.
Need to
Need some
rip up that
carpeting.
carpet. Oh yeah. Carpet is disgusting. Oh, need a new kitchen. Jeez.
Yeah. Oh yeah, that's outdated and dirty. This is why this is why you usually get good deals on these homes. Yeah. Love the paneling and the carpeting, the decor. The closet is an afterthought. Yeah, you got a 2-car garage though.
That's a benefit. They got a backyard too.
Yeah, you got a backyard too. And it's a corner property.
So I googled, and it says in New Jersey, particularly within Italian American communities, a pair of statue of lions in front of a house is often urban legend or cultural nod signifying that the mortgage is fully paid off.
I've never heard that before.
Okay.
I never
So
I really never did.
oh,
First
okay.
time I ever heard that.
It's Google says that.
Yeah. Be careful what Google says too. Even though I do the research using these tools a lot too, you got to be careful what Google says. Sometimes if you look at it, I've known like for some political things, I've done research because I wasn't sure 100%. So I've done some research. On other items, I was 100% positive about the things I was looking up. And Google gave me a different storyline back. So I asked Google's AI, why does Google search results showing things as fact that are not really true? And it says because of culture and what the trends are, what people want to see, and how some news stories are typed up, they may show things as factual data because that's what people want to believe and see. So that's how it presents it to them, even though it may not be fact. Go ahead, ask Google about its own facts, and sometimes it'll tell you that it's lying to you. It's the craziest thing. I guess like AI too, Anyway, HUD home stores where you could go look for those HUD homes. But in order to put offers on them, you need to be a HUD approved agent. But you know what? HUD will pay 5% commission to the buyer's agent for those purchases. Okay, now FHA lender site with great information. This is not, they have no connection with the FHA. It's FHA.com. This is actually a lender's website. It looks kind of cartoonish even. Let me see. Yes, this still does. They're just a lender, but they gathered a lot of good information about the different programs like FHA, the VA. They have programs about these. Look at this. FICO credit scores as low as 580, you could get an FHA loan for. Look, 0 down payment possible, 3.5% down payment with the good credit, or with required credit, which is 580. It's not that great of a credit score. 620 is considered prime. Anything below 620 is considered subprime, which is below average. And 10% down payment without required credit score. Anyway, they give you a lot of information about FHA programs and loans and the information I'm teaching you. They got a lot of that over there with lessons and stuff you can look up on their website. It's pretty cool. All right, so now let's do all the FHA highlighted stuff, so get caught up with the notes. Here's everything you need to know. Here we're going to highlight it in the book. So let's get your highlighting done if you're going to be highlighting, so I could get through these slides here. Otherwise, this is going to take us forever, guys. So just tell me when you got it so I can move on.
Wait a minute. I don't see that sentence. The common what? Oh,
it's on page 276
I got
under
it.
the title FHA insured loans.
Okay, got it.
All right. I'm moving on to the next one. If anybody needs me to get back or hold on a second, you got to let me know. Otherwise, I'm moving forward once somebody tells me they got all the highlights. Here, page 276. And from this point, this is on page 277 down. This is all the stuff we already went over on that one slide. Okay, everybody good?
Yep.
Okay, got to let me know. Just tell me when you got it so I can move on, all right?
Yep, let's go.
All right, next one, page 277, estimate of value and repair requirements. Some notes for you. By the way, I'll also throw out the after lunch attendance poll for everyone. Geez, tomorrow I'm going to have to put the air conditioner on here if this temperature keeps up. I'm on the second floor right now with the window open, and and a fan on. It's tolerable, but it's 88 degrees in here.
All right.
Okay. You know, the interesting thing here is they write the FHA will consider applicants with credit scores as low as 580 in some circumstances. Do you know the FHA does not have a credit requirement? They have no credit score requirement.
Really?
That's the lenders that set it as low as 580. All right. And here we go, page 277 and 278, more of the FHA stuff. That it's owner occupied for owner occupied people. FHA loans may be assumed. FHA 203K loan, and what the purpose of that special amendatory clause is for. Everybody good, or anybody taking notes here? See a couple of you guys are just looking at me.
Ability, hold on, FHA.
Anybody's taking notes, you got to let me know if you need time. I don't want to rush you, but if you're,
hold on 1 second.
if you're not doing it, I want to move on.
Hold on 1 second. 203. Allow one loan to cover both purchase price. Okay. All right.
Right?
Yep.
Here's a house around the corner from me. I think they used an FHA loan. Well, actually, no. I don't think they did. But I've seen projects like this that used FHA loans. So, what exactly does the FHA 203K, their construction loan, consider extensive rehabilitation work? Remodeling a kitchen, putting an addition on, building a garage? What's the limit? How about this? They tear down the entire house, leaving only the garage and one wall. Actually, this wall ended up coming down. It's just they didn't remove the electrical. The power company didn't come to remove the electric line yet. Look at this. Just the garage and that one wall, which eventually came down with that chimney. And they built a brand new house on this part of the same foundation. They left a piece of the original house, which was the garage, and they dug the basement deeper and further out, built the bigger footprint foundation for the house, but they built the entire house around the garage. So, technically speaking, it's not new construction. Even though they tore down the whole house but the garage. All you need is one original wall standing, and it's not new construction. It's a rehabilitation or a remodel.
Wow.
This is an old builder's trick they used to use to fool the tax man, because the tax man and the builder's permitting department, even though they're usually next to each other or across the hall from each other in City Hall, you could probably count on one hand how many municipalities in the state of New Jersey where the building department and the tax department communicate with each other. So this is an old builder's trick that you could get away with paying the same taxes as this guy's paying on his original house with this house that's 3.5 times the size. It may not look it here, but this is the house as they're still building it. You see they still got construction going on here. You could see that this house has a full second story, unlike this one, and it goes back twice as deep as this one.
Wow.
Look at the aerial view. There you could get the better view. This house, this house is about 3.5 times the size of this one. Plus, it has a full basement, the full footprint of this house.
Whoa.
Yeah, that's extensive rehabilitation work that the FHA would allow a 203K loan for. It's an old builder's trick, though, but they allow it.
So FHA 203, that is for that, can that
203.
be used for refinancing as well?
Well, they have separate loans for refinancing. Um, the 203B is the most common type of loan. The 203K is the construction loan. 203B is the fixed rate 30-year mortgage. They have a 203K, which is for the rehabilitation. One loan to buy the house and do the renovation. They have other loan programs like adjustable rate mortgages. They have loans for refinancing. Yeah. But what loan are you going to refinance into? The 203B? Yeah, I don't know. Yeah, they have a lot of different loan programs that they insure. Okay, now let's look at the VA loans. You may want to snap a picture of this slide here. VA loans, formerly called GI loans. GI was general issue. Remember, we used to refer to our military as GIs, or at least they did back in the 50s and 60s and 70s. They called them GIs. It stands for general issue. Everybody got the same underwear. Everybody got the same uniform. Everybody got the same socks, the same gun, the same amount of bullets and grenades. You were just a tool of the military. Okay. In recent years, we've seen people trying to get recruited into the military, telling you how you could express yourself and be an individual. That was under a previous administration where our military enrollment went down the crapper. That's not the way to get people involved in the military. They want to feel like a unit. They work together, not as an individual. You follow the orders of your commanders and fight for your country or do whatever's necessary for your country. They're now called VA loans instead of GI. They don't refer to general issue anymore for the uniforms either. They're intended for veteran owned or co-owned and occupied 1 to 4 family homes. So the VA loans are not for investors. Once again, just like the FHA loans are not for investors. They're for owner occupants. Now, there's been some changes to the VA since 2020. I'm sorry. There's been since then, there's been some changes to the VA loan program. They used to have loan limits like the FHA does. And there's been some changes with that. The VA no longer has lending limits. They'll guarantee 25% of the loan for properties over $144,000 in value. In event that the borrower defaults.
No down payment. Whoosh.
So there's no down payment requirement at all. Yeah, the veteran doesn't have to put down any money. It's 100% financing, and the VA guarantees 25% of the loan to the lender. Okay. There's an amendatory clause that must be added to the purchase contract. It's the same one that must be added to the FHA loans. What does it say? If the property doesn't appraise for the purchase price, the borrower can get out of the contract without penalty. Here's something will be an exam question as well. There's a different name for the appraisal for when you get an appraisal done for a house, when you're getting a VA loan, it's actually called a CRV, a certificate of reasonable value. And that's often a question on exams. What do you call the appraisal statement for, or the valuation statement, appraisal for a VA loan? It's called a CRV, Certificate of Reasonable Value. So they could just give the abbreviation or they could give the full name there. Okay. I tell people the way to remember this is by remembering the most popular car that's out there, the Honda CRV. Okay. CRV, Certificate of Reasonable Value. Okay. For some reason, people associate the car and then they remember it. Discount points may be paid by the seller, the buyer, or shared between them. There's a funding application fee that must be paid by the veteran, or it can be paid by the seller. Now, the part-time military people, National Guardsmen and reservists, they pay higher funding fees. VA loans can be assumed by anybody. You're not required to be a veteran to assume a VA loan.
Really?
You're required to be in the military or be a veteran to get a VA loan, but not to assume one, to take it over.
Oh.
Anybody can assume a VA loan. Now, the eligibility requirements for VA benefits, any benefits, including college, medical, loans. You have to serve 90 consecutive days of active duty during wartime, 181 days of active service during peacetime, or 6 years in the reserves or the National Guard. And you get more information about that through these links I have down here, which are also in the class links Word document. I also give you a couple movies that are military related to check out. Here's one called Stripes. If you've never heard of it, check it out. It's from the 80s. It's funny. It's a comedy. It's really good. Or if you like your military movies to be more like documentaries and true stories, this actually is a true story and documented. It's a documentary miniseries based on actual people that they end up after each episode interviewing those veterans that are still alive that were part of the conflict. And if you guys have never seen it, this is a great series. It's an HBO miniseries called Band of Brothers. I'm sure you could watch it on demand as well. It's about a 10-part series. Each part is maybe about an hour and a half to 2 hours long. So it'll take you a while to get through it, but it's an excellent series. Anyway.
Victor, what do you mean by, please go back to the last slide, that anyone can assume VA loans? And
you do not need to be a veteran or active military personnel to take over the loan.
So 90 consecutive days of active duty during wartime.
No. This is sorry. Don't separate that. I should. Yeah, that's for veterans' eligibility for their benefits in order to qualify for getting the VA loans and stuff like that. I'm sorry about that. Eligibility for veteran benefits. Okay, that's what to be a little more clear.
So now, what does it mean that anyone can assume that loan and not only veterans?
You can take it over. You can't apply for it. So, like, if I was a veteran and I had a house, you could assume my mortgage, meaning I will let you move in and you could pay the payments on the original loan, but you can't get a VA loan in your own name with your qualifications. You would just be paying the payments for the loan that I originally made. Was that
so
good,
basically,
teacher?
Yeah, you're taking over her loan payments. Okay, which that's great because There's no loan origination fees. You don't need to pay for appraisals or application fees. Not that you would be able to even qualify for them under the VA loan program, but uh, that it's great when you're able to assume a loan, particularly if it's at a good interest rate. It saves you on all the fees required for getting the loan, closing the loan. Remember, closing costs are typically include the impounds and such for the coming year's taxes and insurance and all that. You already have the loan in existence. All you have to do is take over the payments of it. You know, so let's just say that Fandrea got a VA loan. She was in the military. She qualifies. She gets a VA loan, and let's say she only had the loan for 2 years. So let's say she paid down maybe, I don't know, $10,000 on the house. Okay. So you still got, let's say it's a $400,000 house. Okay. So you got still $390,000 balance on that loan. But you wouldn't be able, you're having trouble because maybe your credit score is a little banged up or your debt to income ratio is a little bit banged up, right? It's not that good. You would have trouble getting any kind of a loan. But if you can assume a loan, just take over it, she would maybe want to sell you the property, say, hey, listen, I got $10,000 equity in this house already. I tell you what, give me $5,000 and take over the loan payments. Would that be beneficial for you? Yeah, because first of all, you may have trouble getting a loan anywhere else. Second, you're getting a house with already $5,000 equity in it. And third, you're not incurring any loan costs or anything. You're just taking over her payments. And you're the owner of the property. Okay. Now, once again, just like the FHA, older loans you could assume without having to qualify for them. However, FHA and VA, any newer loans that they're assumable, but the person who's assuming the loan would need to qualify for it. So they would need to run your credit and stuff to make sure you're not going to default on the loan. But there's no loan costs to you at all from the VA or the FHA when you're assuming a loan. Okay. So there's everything you need to know about VA loans. If you want to snap a picture of that slide before I move on to the next one where you will highlight the stuff about VA loans. Okay, here we go. Page 278, here's where you do all the highlights now and writing in your couple of notes here and there. You write in that it can be assumed by non-veterans next to the title. Loans are made by local lending institutions. The VA doesn't lend money. VA guarantees 25% of the loan, so therefore no down payments necessary for the veteran. It's 100% financing is possible. Veterans can purchase 1 to 4 family homes, just like with FHA. VA appraisal is called a certificate of reasonable value. And just like with the FHA loan, you got to have that special amendatory clause that says if the house doesn't appraise for the purchase price, the veteran can get out of the contract without penalty. And there are no longer any loan limits for VA. There used to be. I don't know why there are not anymore. However, they do have a minimum amount, which they previously did not, of $144,000 as of 2020. I don't know why. Everybody good with the highlights? Okay. Now we have the NJHMFA. That's the New Jersey Housing Mortgage and Finance Agency. This is a New Jersey state program. This agency offers below market interest loans, so very low interest rates, with a little to no down payment requirement at all. To qualified buyers, not investors, they have to be owner occupants who live in urban target areas. Once again, what's an urban area? Densely populated area. You apply through these loans through various approved lenders that are approved to give the NJHMFA loans. They have programs for first-time home buyers, for live where you work, for people who work at home, for off-peak hour workers to relieve the congestion on the busy roads. And they have loan programs for police, fire, and teacher pension programs. They have interest-free loans of up to $10,000 for homeowners using well water to install the water filtration system. Remember I told you about that? This is that same agency that you could get those loans through. Interest-free, up to $10,000 to put water treatment systems in your house. And they have loans for first-time home buyers with down payment assistance programs. These loans that help with the down payment and closing costs, it's a second loan. It has to be combined with one of their other loans to buy the house. And this loan, as long as you live in the house for at least 5 years, you don't pay it back. They'll lend you the money for the down payment and closing costs that you do not need to pay back if you live in the house for at least 5 years. Okay. So you can get more information about their programs from 1-800-NJ-HOUSE, their consumer website of njhousing.gov, or their home buyers videos and resources on theroadhomenj.com. Remember that home buyers brochure I showed you earlier? Let me click on it because this link is probably not working. Yes, it's not. So let me find that link again in our chat window. I'll copy that and I'll paste that. And I'll update it and fix the slide. Oop. Oop, oop, oop. We're almost done with this chapter, by the way. All right. All right. And for bank-owned properties foreclosed by the NJHMFA, their REO properties, you could get information at this link. Let's see if they didn't change that. No, they did not. That's good. See, these are various resources for government-owned or foreclosed properties. Where are they? Where are they? There are none available. 0 NJHMFA foreclosed properties right now. Otherwise, they'd be listed down here. All right. So let's highlight page 279. New Jersey Housing Mortgage Finance Agency offers below market interest loans with little to no down payment to qualified buyers who purchase homes in what areas?
Rural. Urban. Sorry.
All right, that's an exam question. Be careful when answering so quick, otherwise you get it wrong. You don't want to get something like that wrong where you know the answer, right? And these are, once again, loans for 1 to 4 family owner-occupied homes. And I got to adjust that link right here again because that link is wrong. Oh, that blew up. Let's make that font a little bit smaller. All right. Okay, so here's a little bit more about their programs. You guys could put together videos about this stuff, educating people, hey, this is how you get buyers. You know the different programs and educate them about it. Something called the DPA program, the Down Payment Assistance Program. It's a first-time home buyers program. Now, what is a first-time home buyer? A first-time home buyer is anyone who has not owned a home in the last 3 years. My head hurts. This is the way the government thinks. They define things. You're a first-time home buyer if you didn't own a home in the last 3 years. Borrowers' income must not exceed 140% of the average income in the area. A second loan of up to $15,000 for down payment assistance is available, plus an additional $7,000 if you're a first generation home buyers. I don't want to even take a guess of what's considered a first generation home buyer. For a total of $22,000 that they would lend to you, and you don't have to pay back as long as you live in that house for at least 5 years. Okay, as long as you combine it with one of their 30-year fixed rate loans. Now, in the past, I'm not sure if this is still a requirement. In the past, in order to qualify for any of these loans, you had to take a one-day class with them, teaching you how to balance your checkbook and how to do some simple basic home repairs like changing a washer in a water faucet, or changing the filter on your HVAC unit, your air conditioning and heating unit. Because these are little costs that if you had to call a professional to come in and do these basic things, it ends up costing you a lot of money for simple repairs you could have done yourself. And then people end up bowing out of home ownership and don't stay in the houses for the long term. So they teach you how to do some simple repairs in the household and how to balance your checkbook in this one-day class in order to qualify for this loan as part of the qualifications. I don't know if they still do that, but they used to. Now, the second loan for the DPA program is at 0% interest, and it's self-liquidating, meaning that it's a forgiving loan as long as you live in it for at least 5 years. So it works like this. If you sell the house after 5 years, you don't pay back any of that money from that down payment assistance loan, that second loan of up to $22,000. Sell it within 4 years, you pay back 25% of it. 3 years, 50%, 2 years, 75%, a year or less, you sell that house, you pay it all back. So here's some of their loan programs and some of their links and resources where you could use for maybe adding to your own websites to have original content to attract people to it. And once again, I got that home buyer's guide link over here that I need to change yet again. Oh. Yeah. All right. And here's the Rec D. Here's another loan program for people who live in rural areas, farmers, or live on Indian reservations. You could get this is once again for owner occupants, not for investors, 1 to 4 family home. These loans are subsidized with interest rates as low as 1%. 1% interest rate for modest homes. Now, what is modest? You could take a guess, probably 700,000. Right. For modest homes for people who live in rural areas. These loans come directly from the United States Department of Agriculture through the Rec D. 100% financing is available for them. And you can get additional information down here. Now, what is considered rural? They used to have a map there, and it's easy to figure out. They buried it. They changed the information. They made it harder to locate. So let me see what that link takes you to now.
This can
What
be on
is,
farmland also.
yeah, it could be farmland. It could be just rural and you're not a farmer. Now, what is rural? Let's see. Urban communities range from 5,000 to 50,000 people living in the area. Okay. See, their rural explanation is based on population. Did you know that most of Somerset County is considered rural? You could get one of these loans to buy a house, 100% financing at a 1% interest rate in Somerset County. We do have some counties in New Jersey that are considered rural. Union and Middlesex County are not one of them. They used to have a tool where you could click on it. I guess you could click on these charts and look, but they used to have a tool that you could put an address in and it zooms to it. Instead, here you got to download this very large file, and then you could zoom in and float around. But I'm trying to find what is not urban, but what is rural. Okay, so this is what a rural populated area is. If it's a non-metro county, population is less than 29,000. Metro counties, 36 or close to 37,000. And you can find that out by looking at their maps. Hold on a second. Feedback. Yeah. They used to have like an interactive map where you could plug in an address. Instead, I think you could download the data. I guess you could make your own interactive search map using their data here on their website if you have those skills. Damn, I got a lot of windows open in my browser. Surprised it's not crashed yet. Look at that. I got about 30 windows open up top. All right, so Rec D, 100% financing, 1 to 4 family, rural areas. Loans come directly from the USDA through the Rec D, the Rural Economic Community Development, formerly the Farmers Home Loan Association. So here we could highlight that, and right here, loans funded by the USDA for rural areas. Subsidized as low as 1%. Wow. Actually, they don't say anything here about it being 100% financing, but I'm telling you, it's 100% financing is available. All right, that concludes this chapter. Let's do the key terms to review. That was a long one. Chapter 15 is going to be quicker. It's shorter. But so tomorrow we'll do 15, 16, and I don't want to push it, but possibly get started in 17. But let's just say 15 and 16 will be our goal for tomorrow. Okay. There's only two key terms to review for, oh, sorry, that's chapter 16. Chapter 14, two key terms to review. Are you ready? Let's do this. Mortgage payments that can be taken over by the next buyer. What do we call those?
Assumable loan.
Yep. 3 is A, assumable. Highest interest rate ever allowed on a specific adjustable loan.
Ceiling.
Ceiling, 7 is B. Repayment plan, the equivalent of 13 monthly payments per year.
Mortgage.
Bi-weekly mortgage.
Correct. 4 is C, biweekly mortgage. Plan with interest rate periodically changed up or down.
Arm.
Yep. 1 is D, an ARM, adjustable rate mortgage. Written estimate of value by a real estate licensee, not an appraisal.
CMA.
8 is E, the CMA, put slash BPO.
Yeah.
Wait a minute. Go back to
8 is E.
right, but what's D? Did you do that one? 1?
1, yeah.
Okay.
All right. A repayment plan, the principal and interest that gradually reduces debt.
Amortization loan.
2 is F. Percentage beyond which interest rate cannot be raised at adjustment.
Cap.
6 is G, the cap. Payment of extra points in return for a lower interest rate.
Buy down.
5 is H, buy down. Difference between current value and money owed.
Equity.
10 is I, equity. VA appraisal statement.
A certificate of reasonable value. J.
9 is J, that's correct. All right.
What's that? Sorry.
9 is J, the certificate of reasonable value, the CRV.
No. Have you learned about that?
Yeah. What do you call that's on the VA slide, in the VA section. What do you call the appraisal statement for a VA loan? It's a CRV, certificate of reasonable value.
Oh, CRV.
Yeah, I said a lot of people remember it by thinking of the Honda CRV vehicle. Yeah. Okay, let's do key terms 2. Loan guaranteed by the federal government. Who guarantees loans?
A VA.
10 is A, the VA. Protection for lender on low down payment conventional mortgages.
Private mortgage insurance.
PMI, 7 is B. Mortgage payment including amortization, interest, and certain expenses.
PITI.
A pity loan, which is sometimes referred to as a budget loan. That is correct. 5 is C. Percentage of the property's value that could be borrowed.
Loan to value ratio.
The LTV, the loan to value ratio. 4 is D. Lender agrees to hold the interest rate for a certain period of time.
Rate lock.
Rate lock.
8 is E. It is a rate lock. 1% of a loan amount charged as an upfront interest when the loan is made.
Point.
6 is F, point. Low down payment insured mortgage loan. Most common loan out there.
FHA 203B.
FHA 203B. 1 is G. That is correct. A mortgage with payments of interest only.
A straight loan.
9 is H. It is a straight loan. which is an interest-only loan. Charge for the use of other people's money.
Interest.
That's the rent you pay. Interest is correct. 3 is odd. And a guide to national mortgage trends used for adjustable rate mortgages.
Index.
It's some sort of an index. A lot of lenders use the 1-year U.S. Treasury bill. That is correct. So there you go. That concludes chapter 14.